Please like, share, and subscribe. Wishing you happiness and good luck every day.
Welcome to The Explainer. Today, we're diving into the story of the world's greatest money-making machine, a super secretive hedge fund that basically tore up the Wall Street rulebook. And the craziest part? The guy who started it all had never even taken a finance class. So let's just start with a number that sounds made up. 66%. That's the average return Renaissance Technologies' main fund, Medallion, has pulled in every single year since 1988. I mean, that's before fees, but still, it's a number that just shouldn't be possible. And that kind of performance, it's generated over $100 billion in profits. To give you some perspective, that absolutely blows legends like Warren Buffett, George Soros, and Ray Dalio out of the water. It's not even a competition. Which brings us to the big, fascinating question we're going to tackle today. How on earth did a total outsider, a guy who genuinely disliked the whole idea of business, end up building the most dominant money-making machine the world has ever seen? Okay, first up, let's try to wrap our heads around the sheer scale of this thing. The numbers are just so wild, it almost feels like we're talking about alchemy, somehow turning pure data into mountains of gold. So who's the genius behind these unbelievable returns? You're probably picturing some slick Wall Street shark, right? Well, the reality could not be more different. Meet Jim Simons. This guy never took a single finance class, not one. He didn't really get into trading until he was 40. He was a pure academic, a codebreaker for the NSA during the Cold War, and a professor who studied the most abstract, theoretical math you can imagine, the kind of stuff that has no obvious real-world use. And this table just lays it all out, doesn't it? It shows the huge clash of worlds. On one side, you have the old guard of Wall Street, running on gut feelings, intuition, and company reports. And on the other, you've got Jim Simons, who threw all of that in the trash. He believed the answers weren't in your gut. They were hidden in the data, waiting to be found by math and computers. But, and this is a huge but, this radical idea was not an overnight success. Not even close. In fact, for years, it was a total failure. It was a long, painful slog to find a formula that actually worked. Just look at this timeline of pain. We're talking about more than a decade of one brutal setback after another. It got so bad at one point that an employee of his was genuinely worried that Simons was contemplating suicide. That's how dark things got. You know, he tried teaming up with other brilliant mathematicians, but it always fell apart. They'd argue, they'd lose money, and the partnerships would just crumble, forcing Simons right back to the drawing board. And his own early attempts at trading, when he tried to use his intuition like everybody else, an absolute disaster. The volatility, the crazy ups and downs, made him literally sick to his stomach. It just proved to him that human emotion had to be taken out of the equation. And then, in 1989, it all just stopped. The results were terrible, another one of his key partnerships was falling apart, and he had to pull the plug and halt all investing. For most people, that would have been the end of the story. And yet, through all of that failure, Simons held on to this one single, unwavering belief. He was totally convinced that markets weren't random, that there were patterns hidden in all that noise, and if he could just get enough data, he knew he could find them. So, to finally prove his wild theory, he had to build the right team. But he wasn't looking for Wall Street traders or guys with MBAs. Nope. He went out and assembled a crew of fellow scientists, a bunch of outsiders who saw the world the way he did. His firm pretty much became a sanctuary for people who would never fit in on Wall Street. He hired guys like Robert Mercer and Peter Brown, these brilliant computer scientists from IBM. Now, get this. Their job at IBM was teaching computers to understand human languages, finding statistical patterns that hidden grammar to do machine translation. Simons basically made a bet that the skills used to find signals in language could find signals in financial data. He wasn't hiring stock pickers, he was hiring world-class pattern finders. And this motley crew of outsiders, they didn't just build a successful company. Oh no. They accidentally started a revolution that completely changed the investing world forever. What they pioneered is what we now call quant investing. The whole idea is to turn trading from an art into a cold, hard science. Instead of just looking at stock charts, their system gobbled up everything. Historical weather patterns, currency prices, commodity futures, you name it. It was looking for tiny, temporary signals that might predict where prices would go, and then it would make trades automatically, faster than any human ever could. And look at the result. By 2019, the Quants, the intellectual descendants of Simons's crazy idea, had become the single biggest group of players in the market. They were controlling almost a third of all stock trading. The nerds had officially taken over Wall Street. So, what's the big takeaway from this incredible story? After all that, what does finding patterns in all that financial chaos really mean? Well, the success of Simons and his team really boils down to this amazing paradox. The people who should have been the least likely to solve the market, academics and scientists who didn't really even like capitalism, were the ones who cracked the code. It's just an incredible historic irony. And that leaves us with one last, pretty challenging thought. We now live in a world that is increasingly run not by gut feelings or human judgment, but by data and algorithms. So, does the story of Jim Simons prove that when it comes to making really complex decisions, the machine is just better than us? All right, so today we're going to dive into the early life of a true legend, a man who would eventually revolutionize the entire financial world. But way before he was a billionaire hedge fund manager, he was just Jimmy Simons. And honestly, his early days gave you almost no clue about the quantitative storm he was about to unleash. So let's jump right in at the beginning. Okay, picture this. It's 1952. A 14-year-old Jim Simons has a Christmas job at a garden supply store. And he's so busy daydreaming about math and, well, girls, that he can't even keep track of, get this, sheep manure. So when the owners ask him what he wants to do when he grows up, he tells me he wants to study mathematics at MIT. And they just laughed in his face. And this, right here, is the perfect setup. It just brilliantly captures the whole contradiction of his youth. I mean, think about it. The kid who was so out of it, he gets demoted to sweeping floors, is the same guy who's going to build a system to track and predict the movements of the entire global financial system. It's the perfect start to the story of a hidden and often underestimated genius. So you gotta wonder, right? Where did a mind like this come from? Well, to really get Jim Simons, you've got to look at his family, the powerful and sometimes contradictory people who really built his foundation. You know, the dynamic between his parents it's pretty fascinating. So on one hand, you've got his mom, Marcia. She was sharp, witty, and incredibly ambitious for him. Simons himself said she kind of saw him as her project. And then you have his dad, Matty. Super kind, easygoing, a sales manager who just loved spinning these wild, tall tales for the family. He really provided the humor and the heart. And, you know, it was actually a lesson from his dad that really stuck with him his whole life. See, his dad, Matty, had given up this really cool career at 20th Century Fox to join his father-in-law's shoe business. He did it out of obligation, and he kind of regretted it. So he told his son, Jim, to never, ever make that mistake. Always go after what you love, not what you think you're supposed to do. And that advice, it became a core principle for Simons. And then there's his grandfather, Peter Cantor. I mean, this guy was a total character, like straight out of a movie. A flamboyant, risk-loving shoe factory owner, driving around in Cadillacs, gambling on horses, and always carrying this huge wad of cash. He taught Simons and his cousin Russian swear words. He just had this love for life and this carelessness about risk that, yeah, you can definitely see in the man Simons would become. So, okay, you've got his dad's advice to follow his passion, his grandfather's flair for the dramatic, and with that, Simons heads off to chase that passion, mathematics. And that journey took him to one of the toughest universities on the planet, MIT. And wow, his rise through academia was just meteoric. He blew through high school in 3 years, gets into MIT at 17, has his bachelor's degree by 20, and a PhD from Berkeley by the time he's 22. I mean, look at this. On paper, you'd think, wow, this guy's a prodigy. It was all easy for him. But yeah, the reality was a whole lot messier. Yeah, you heard that right. His first couple years at MIT, a total disaster, by his own admission. He was a little cocky, signed up for a graduate-level class as a freshman, and just got completely steamrolled. He even pulled a D in a high-level calculus course. So yeah, genius isn't always a straight shot to the top. But then he had his breakthrough, his real aha moment. It came in a class on something called Stokes' theorem. Now, this is just a beautiful piece of math that connects all these seemingly separate fields. And for Simons, seeing how calculus, algebra, and geometry could just click together into something so simple, so elegant and powerful, it was a total revelation. He said he just blossomed. And that vision, that feeling, it all got locked in one night. He saw two of his professors, who were these world-famous mathematicians, just passionately debating ideas in a cafe after midnight. And for him, that was it. That was the moment. He was like, that's the life I want. Not a job, a total all-in immersion in the world of ideas. Okay, but don't go thinking he was just some quiet bookworm, staring at chalkboards all day. Oh no, there was a completely different side to Jim Simons, a mischievous, risk-taking adventurer who was just as curious about life outside the lecture hall. Okay, this slide, this just gets me every time. To get out of a regular gym class, he signs up for archery. As a freshman, he builds a homemade flamethrower with a water pistol and lighter fluid. He even accidentally sets a bathroom in his dorm on fire, and then had to sheepishly pay the university back $50 in installments. So yeah, definitely not your typical math nerd. And that taste for adventure, it went way, way beyond a few dorm room pranks. Before grad school, he and some friends decide to ride motor scooters all the way from Boston to Buenos Aires. This trip was absolutely insane. At one point, they get surrounded by an angry mob with machetes. Then they get arrested and thrown in jail, only to get bailed out by the town's Harvard-educated mayor, who then treats them to this huge fancy dinner. I mean, you just can't make this stuff up. And his love life? Just as wild and impulsive. He meets this 18-year-old Wellesley student, Barbara Bluestein. They talked for just 4 nights, and bam, they're engaged. Her parents were absolutely furious, but it didn't matter. They just drove to Reno and got married on a whim. He even used the last of their money to buy her a bathing suit after he won a little bit playing poker. So let's recap, right? You've got this brilliant, restless, adventure-seeking mathematician. It was really only a matter of time before these two sides of him, his love for an intellectual puzzle and his craving for action, were gonna collide. And that collision, it happened in the stock market. So they get $5,000 as a wedding gift, and Simons marches into a Merrill Lynch office and buys some plain vanilla stocks. He watches them for a few days, they barely move an inch, and he's just bored out of his mind. He goes right back to his broker and is basically like, come on, this is boring. Do you have anything more exciting? So the broker says, well, there are these things called soybean futures. Simons knows absolutely nothing about them, but he dives right in. He buys a couple contracts, and in just a few days, the price goes through the roof. He's made thousands of dollars. He's on top of the world. But then, an older friend tells him to sell, take the profit, and he doesn't listen. And just like that, the price plummets all the way back down. He barely broke even. But here's the thing, and this is so important. He didn't walk away thinking, oh, that was a mistake. No, he walked away totally hooked. It wasn't about the money he almost made. It was the wild swings, the action, the game itself. He said it was kind of a rush. And that feeling planted a seed. It would be a while before it sprouted, but it was definitely there. But even with all this incredible success in academia, that restlessness, that feeling that something was missing, it just kept nagging at him. He was on the perfect career path for any mathematician. But for a guy like Simons, it started to feel like a trap. I mean, just look at this career path. It's all over the place. He gets his PhD, lands a great teaching job at MIT, then quits after a year to go start a flooring business in Columbia, of all places. That doesn't work out, so he comes back to a research job at Harvard, but he's totally uninspired and so broke he's secretly teaching classes at a local junior college. He was scrambling, and he was deeply, deeply unfulfilled. And it all just kind of boiled over one day in a conversation with his wife. He's only 23 years old. He's got a career that any academic would kill for sitting right in front of him. And he turns to Barbara and asks, is this it? Am I going to do this my whole life? There has to be more. I mean, that one question, it just perfectly sums up his entire early life. So this is where we're going to leave him for now. A brilliant mathematician with a huge appetite for risk. A guy who could see the deep beauty in an abstract theorem, but also got a real thrill from a volatile market. He was totally convinced the normal path wasn't for him, that his great challenge was still out there, waiting for him to find it. The big question is, what's a guy like that going to do next? All right, welcome back. Today, we're jumping into the backstory of a true legend, but long before anyone knew his name in the world of finance. I'm talking about the legendary mathematician and codebreaker, Jim Simons. And his wild journey from academia to the front lines of the Cold War really kicks off with a classic, kind of nerdy joke. So go ahead and think about it for a second. What is the difference between a PhD in mathematics and a large pizza? And there you have it. It's a good line, but for a young Jim Simons back in 1964, it was also kind of true. Look, he had a growing family. He had bills to pay. So he made a choice that would change his life forever. He quit his teaching gig at Harvard to join a top-secret group of minds fighting the Cold War. The pay was literally double, and that one decision set him on a path he could have never imagined. So here's the journey we're about to take. First, we're going to sneak inside the incredibly secretive world of Cold War codebreaking. Then we'll see how Simons was living this double life, balancing secret work with a brilliant career in pure math. After that, a dramatic clash with politics that gets him fired, and we'll watch him rebuild by turning a small department into a math powerhouse. We'll then explore this time of huge personal change, just as he was hitting his professional peak. And finally, we'll pinpoint the exact moment that pulled him toward his ultimate challenge, the market. Okay, so first stop. Simons lands at the Institute for Defense Analyses, or IDA. Now, you gotta understand, this was not your typical research group. This was an elite team of mathematical geniuses hired by the NSA to crack the toughest, most complex Soviet codes. Simons was right there on the front lines of the Cold War, using abstract mathematics as his weapon. And this list of skills here, this is so much more than just a resume. This is basically the blueprint for everything Simons would do later. At the IDA, he learned a whole new way of thinking. He learned how to build models to find tiny signals in a sea of noise, how to write algorithms and run them on some of the world's most powerful computers. And maybe most importantly, he learned how to manage brilliant, sometimes kind of weird people. These skills would become the absolute foundation of his financial empire. And this was the motto they lived by at the IDA. And I just love this quote: "Bad ideas good ideas is terrific, no ideas is terrible." It tells you everything you need to know about the culture. They weren't afraid to fail. They wanted you to throw crazy ideas out there because the only thing that was truly unacceptable wasn't being wrong, it was having no ideas at all. That philosophy got baked right into Simons' DNA. And this just paints such a vivid picture of how unique that place was. Inside the walls, it was super open and collaborative. When someone cracked a problem, they'd pop champagne, they had daily tea time, they'd play high-stakes poker all night, with Simons usually winning. They even had to chip in to bail Simonson out of jail for all his parking tickets. It was this perfect storm of brilliant oddballs, and Simons saw firsthand how an environment built on trust and even a little bit of fun could lead to incredible breakthroughs. So you have to picture this guy. While he's spending his days hunting for Soviet secrets, he's also pursuing this deep personal passion for pure, theoretical math. He was literally living a double life, a top-secret government codebreaker by day and a world-class geometer by night. His specialty was a field called minimal varieties. Now, I know, that sounds incredibly complex, but the best way to think about it is actually pretty cool. Imagine you have a twisted wire frame and you dip it into soap. That shimmery soap film that forms, that's a minimal surface. It's the shape with the least possible area for that specific boundary. Simons was obsessed with figuring out if that same beautiful, simple principle held true in much higher, more abstract dimensions. It was a quest for the universe's hidden rules. And this is where things get really interesting, because this is where his two worlds smash right into each other. He and a few guys from the IDA started applying their code-breaking tools to the stock market. And just look at the difference here. Traditional investors are all about the why. What's the news? What are the earnings? Simons' model didn't care about any of that. The whys didn't matter. They figured the market had hidden states, kind of like moods, and you could detect them with patterns. It's like in poker, right? You don't need to know why your opponent is nervous. You just need to spot the tell and bet accordingly. This idea was so far ahead of its time. So at this point, Simons is on top of the world. He's a star codebreaker, a respected mathematician. He's in line for a big promotion at the IDA. He's got it made. And then the Vietnam War happens, and his personal beliefs were about to slam head-on into his career. As the debate over the war was raging, a top general wrote an article in the New York Times defending it. Simons, who was strongly against the war, just couldn't let it go. He wrote a letter right back to the editor, arguing that America's money was better spent fixing problems at home. I mean, think about that. For a guy working in a top-secret defense organization, this was an incredibly public and defiant statement. But it didn't stop there. A reporter from Newsweek reached out for a story on defense workers who were against the war. And this is where, in his own words, Simons was a wise guy. He told the reporter that because he disagreed with the war, he had decided to stop doing any defense work and would only focus on his own personal math research until the war was over. Now, this was just a personal goal, not some official policy, but he went and told it to the world. Well, the fallout was swift, and it was brutal. His boss, General Maxwell Taylor, found out about the article before it was even published. Simons got called into the office, and even though he was supposed to be a permanent member of the staff, the message was painfully clear. He was fired. Just like that. At 29 years old, with 3 kids, he was out of a job. It was a shock that taught him he needed to be in control of his own destiny. So what does a fired math genius do next? Well, after a brief thought about selling bonds on Wall Street, little foreshadowing for you, he found his next big project. He was hired to be the chairman of the math department at SUNY Stony Brook. And at the time, let's be honest, it wasn't exactly a world-renowned institution. His mission? To turn it into the Berkeley of the East.
And the way he did it was just incredible. He basically created this recruitment playbook using everything he'd learned about managing talent at the IDA. He went after the killers, the most ambitious mathematicians he could find. He customized his pitch for every single person, offering more money to some, more freedom to others. He even wore down one top recruit by mailing his family little care packages of pebbles from a Long Island beach. And above all, he recreated that IDA culture. Collaborative, fun, and exciting, a place where geniuses wanted to be.
So the 1970s, this was a really strange, contradictory time for Simons. Professionally, he was building one of the best geometry centers on the planet, a place just buzzing with energy and ideas. But at the same time, his personal life was really falling apart. It was this period of huge success set against a backdrop of deep personal struggle. This timeline really puts it all in perspective. In '74, he co-publishes the now famous Chern-Simons theory, this groundbreaking work connecting geometry and physics. But right around then, his marriage to his first wife ends. Then, in '76, he wins the Veblen Prize, which is basically the Nobel Prize of geometry. It solidifies his legacy as a true giant in the field. And then, by the end of the decade, he finds love again, marrying his second wife, Marilyn. Just an incredible roller coaster of a decade.
Okay, so by the late 1970s, Jim Simons has done it all. He's at the absolute peak of the academic world. He built a legendary department. His own work would be studied for generations. But you know guys like this, right? They get restless. He was looking for a new puzzle to solve, a new mountain to climb. And that's when a small, old investment suddenly came roaring back to life in a way he never expected.
$6 million. That's the number that changed everything. Simons and a few buddies had put some money with an old friend who was using some early computer models to trade commodities. When sugar prices went through the roof, their investment exploded tenfold to $6 million. Now, one of his friends was actually depressed by making money that had, in his words, no socially redeeming value. But Simons, he had the opposite reaction. He felt the thrill. The bug had bitten him. Hard. So he decided he was going to do it. He was leaving the noble, pure world of mathematics for the messy, chaotic world of finance. And his academic colleagues? They were horrified. Just listen to this quote. To them, the pursuit of knowledge was a sacred calling. The pursuit of money was, well, it was seen as beneath him. A lot of people really thought he was throwing his talent away. And that was it. The decision was made. In 1978, at 40 years old, at the absolute peak of his profession, Jim Simons walked away from a celebrated, tenured career to start all over again in a world he barely understood. He was trading the quiet certainty of a blackboard for the wild chaos of the market. And that really leaves us with the big question, doesn't it? Was this a brilliant mind squandering his gift like all his colleagues thought? Or had Jim Simons, the geometer, the codebreaker, had he just found a new, even more complex puzzle to solve? A chaotic system filled with hidden patterns that no one had ever truly been able to master. The world was about to find out.
You've probably heard of Renaissance Technologies, the most successful hedge fund in history. But what you probably haven't heard is its origin story, because it's not a story of clean, easy success. It's a story about chaos, about spectacular failures, and about a brilliant mathematician who had to watch his first attempt completely fall apart to build a legend.
Yeah, that's Jim Simons. And believe it or not, getting fired is exactly where this all starts. For him, losing his job wasn't the end. It was the beginning of a whole new career, one that would pit him against the markets, his own gut instincts, and even his closest friends.
All right, so here's the game plan for this explainer. We're going to start with Simon's wild bet, see how he got his team of geniuses together, then watch their early success and the absolutely hilarious potato fiasco. From there, we'll dig into the conflict that broke the company apart and land on the big realization that changed everything.
Okay, let's set the scene. It's the summer of 1978. Jim Simons, a world-famous academic, is starting from scratch. And well, talk about a change of scenery.
So, forget whatever you picture when you think of a hedge fund office. This was not it. We're talking a rundown strip mall, right next to a pizza place. Simons, at 40 years old, has gone from a beautiful university campus to a stuffy little office with bad wallpaper and even worse phone service. I mean, this guy was a giant in the world of math, and now he's a nobody on his fourth career with pretty much everyone betting against him.
But here's the thing. Simons had this radical idea. Everybody else was looking at the markets and seeing economics or psychology or just pure chaos. Simons looked at the exact same thing and saw a science problem. He was convinced that just like the weather, the market wasn't truly random. It just looked that way. He believed that hidden underneath all that noise, there were patterns, there was structure, and he was going to be the one to find it.
Now, a theory that big, you can't tackle that solo. Simons knew he needed help. He needed some serious, heavyweight brainpower on the problem. And that brings us to his first and maybe his most crucial hire.
Meet Lenny Baum. This guy was the real deal. A Harvard PhD and a legendary codebreaker. In fact, a lot of people who worked with both of them said Baum was even better at breaking codes than Simons was. He was this quiet, brilliant, absent-minded professor type. The kind of guy who once showed up to work having only shaved half his face because he got distracted mid-shave by a math problem.
So what made Baum such a big deal? Well, his most famous work was something called the Baum-Welch algorithm. It's a brilliant way to figure out what's happening behind the scenes when you can only see the results. Here's a way to think about it. Imagine you've never seen a baseball game. If you only looked at the final scores of thousands of games, this algorithm could help a computer teach itself what probably happened. Like, it could figure out the concept of a home run without ever actually watching a single play.
And listen, this wasn't some dusty academic theory. This algorithm was a total game changer. It became a cornerstone of modern machine learning. It was the tech behind the very first speech recognition systems. It's part of the DNA of Google's search engine. Today, it's used everywhere from mapping genes to predicting the weather. So that's the level of genius that Simons just brought onto his little strip mall team.
So you've got these two titans of math teaming up, and their first strategy, well, it wasn't what you'd expect. It was this wild, messy blend of some very basic computer models and a ton of human gut feeling. And you know what? For a little while, it was pure magic.
Okay, get this. The year is 1979. Lenny Baum is on a beach, of all places, when it hits him like a bolt of lightning. He has this sudden gut feeling about the British pound. He was sure Margaret Thatcher couldn't keep its value down. He literally sprints to the office and tells everyone, that's nothing, it's going to go up 50 cents, maybe more. And he was totally right. The pound just took off. They rode that wave and then did it again, making huge winning bets on the yen, the Deutsche Mark, and the Swiss franc. We're talking tens of millions of dollars rolling in. This weird mix of man and machine, it felt unstoppable, like they'd actually cracked the code. But you know how these stories go. Just when they thought they had it all figured out, the whole thing started to unravel. And that brings us to, honestly, one of the most famous and hilarious blunders in financial history. So they build one of their first automated trading systems. They call it the piggy basket. Cute, right? Because it traded hog futures. The idea was pretty simple. Just pump it full of market data and let it spit out recommendations on what to do. This was supposed to be the next big step towards Simons' dream of a totally hands-off system.
And at first, it worked perfectly. The piggy basket was making money hand over fist. Simons is thrilled, so he pours millions more into it. And that's when things got weird, really weird. The system, for reasons nobody could figure out, got obsessed with Maine potatoes. Not kidding. It just started buying potato futures, and it didn't stop. It just kept buying and buying until it had sunk 2/3 of their money into spuds. They were on the verge of accidentally cornering the entire world's potato market.
So you can just imagine the phone call from the regulators. Simons is apparently trying not to laugh his head off while a government agent is asking him if he's plotting to take over the global supply of spuds. It's hilarious, but the regulators didn't think so. They forced them to sell all the potatoes, losing millions in the process. And this revealed the huge, scary problem. The system they built was a black box. It was making trades, but they had absolutely no idea why.
Okay, so a rogue computer that loves potatoes, that's a system problem. But there was a much bigger, much more human problem bubbling just under the surface. This was about a fundamental disagreement between Simons and Baum, a clash of personalities that was about to blow everything up.
I mean, you couldn't find two people with more opposite approaches to trading. Simons was always cautious, always terrified of a bubble bursting. His instinct was to take the profits and run. Baum, he was a total optimist, a true believer. He thought the good times would just keep rolling forever. And this all came to a head when gold prices were going through the roof. Simons saw a frenzy and wanted out. He famously screamed at Baum, "Sell the fucking gold, Lenny." But Baum just wouldn't do it. He was convinced the trend would continue. Simons eventually had to force the sale. And of course, he was right. Gold crashed soon after.
But that fight over gold, that was just the beginning. It was one disaster after another. Later that year, there was a terrible bet on coffee, where again, Baum was paralyzed and just couldn't bring himself to sell. Then, in 1984, a huge bet on U.S. bonds went completely sideways. That was followed by one last failed wager on the yen. Baum's optimism, his inability to cut his losses, was becoming a catastrophic problem.
And the way it all ended, it's actually kind of sad. It wasn't some big, dramatic blow-up. Baum's portfolio just kept losing money until it hit a 40% loss. And when it did, it triggered an automatic clause in their contract. And just like that, Simons was forced to liquidate everything. A decades-long friendship between two mathematical giants, it didn't end with an argument, it ended with the execution of a contract.
So let's take stock. Baum is gone. The fund is bleeding money. Simons has lost his partner, his confidence, and his way. He's hit absolute rock bottom. But it was right there, in that moment of crisis, that the true vision for Renaissance was finally born.
And you can really feel how lost he was. During the worst of it, he actually confessed to a young programmer, "Sometimes I look at this and feel I'm just some guy who doesn't really know what he's doing." Can you imagine? This is Jim Simons, a guy known for his bulletproof confidence, admitting he's completely in over his head. He had tried this hybrid model, and all it had led to was chaos, a broken friendship, and gut-wrenching losses.
But out of that despair, something clicked. He sat down with a colleague and laid out a brand new goal. He said, "I don't want to have to worry about the market every minute. I want models that will make money while I sleep." He was done with intuition, done with gut feelings, done with emotional decisions. The pain of the last few years had forged a new conviction. The only way forward was a pure system, with absolutely no humans getting in the way.
So that became the new mission. He had seen firsthand how human emotion, greed, fear, optimism, could just destroy everything. Now he was going to build a machine that could trade without any of that baggage, a pure system that could find those hidden patterns he always believed were there. The goal was set, but it left one huge hanging question. Could something like that actually be built?
All right, let's dive into the origin story of one of the most secretive and, one of the most successful hedge funds ever. We're going to rewind the clock and see how a world-class mathematician got so fed up with investing that he decided to build a machine to do it for him.
You know, this quote from Jim Simons just nails it. It perfectly captures the emotional roller coaster he was on. Here's a guy who's a legit genius in mathematics, but when it came to trading, he felt just like the rest of us. The wins made him feel brilliant. The losses made him feel like an idiot. It was a total nightmare, and he just knew, there had to be a better way.
So what does a brilliant mathematician do when he's had enough? He decides to take the human element out of the equation entirely. His big idea was to do it mathematically. He was going to build a system, an algorithm, that could trade completely free from all those gut feelings, the highs and the lows that mess things up for us humans. And that right there is where our story really begins.
So, Simons was just done. He was done with the anxiety, the second guessing, all of it. He gave himself a new mission, a mandate really. Build a trading system that was purely mathematical. No gut feelings, no instincts, no exceptions.
Now, he knew he couldn't do it all by himself. He needed to find the right person for the job. So he decided to bet big. He was going to pour a ton of resources into one single person, a mathematician he knew from his old Berkeley days, who he thought was just the right kind of brilliant to pull this off. And that man's name was James Axe.
And let me tell you, troubled genius is maybe the perfect way to describe James Ansitz. He wasn't just some smart guy. He was a true force of nature. And you really can't understand how this all came together without understanding the, let's call it the chaotic creative energy this guy brought to the table. Okay, just look at this. It's like we're talking about two completely different people. On the one hand, you've got this incredible prodigy, wins the super prestigious Cole Prize, becomes the youngest full professor ever at Cornell. I mean, the guy's resume is unbelievable. But then there's the other side. This is a guy who wore a ski mask to a poker game because he thought his tells were being read. He literally kicked a hole through an office wall. A fist fight with a colleague? Yep, that happened too. Wow, that quote, it just says so much, doesn't it? It shows you where his head was at. He really struggled with things that weren't based in pure logic. After a tough divorce, he barely saw his own sons. It seems like if he couldn't solve something like a math problem, he just didn't know how to connect with it. So again, his academic career was just stellar, top of the line. He gets his PhD from Berkeley, which is where he first meets Simons. His work was groundbreaking stuff in number theory. But then, in 1979, he decides to walk away from it all. He leaves the ivory tower of academia for this wild new challenge, building Jim Simons' trading machine. So Axe gets to work, but honestly, his first models weren't anything special. He was using pretty basic ideas, things like moving averages that a lot of traders were already using. But they hit a huge snag right away. The historical data they were using to test everything, it was a complete and total mess. It was full of bad prices and errors, which made their models pretty much useless. Garbage in, garbage out, right? Okay, so if your fancy math is worthless without good data, what do? You've got to find a data person. But they didn't just need anyone. They needed a different kind of genius. Not a big idea theorist, but someone who was absolutely painstakingly obsessive about getting things right. They found him in a guy named Sandor Strauss.
So, Sandor Strauss was working at a university computer center, feeling kind of bored and definitely underpaid. Simons comes along and offers to double his salary. I mean, who says no to that? So he joins the team, and Axe gives him what sounds like a simple job. Go get us historical price data. But what Strauss finds is that all the available data is junk. And what started as a task quickly turned into a full-blown obsession. He started this epic quest to clean it all, checking every single data point against old newspapers and records. He basically became the bedrock of the entire company.
In this quote right here, this was his big aha moment. Strauss realized this was what he was meant to do. He wasn't just some computer guy anymore. He was like a data archaeologist, digging for treasure that nobody else even knew existed. He saw the potential, he was on the trail of something huge, and there was no way he was going back to his old job. He was hooked.
So by 1985, they have their data guru, and Axe decides he wants a change of scenery. He moves the whole operation out to Huntington Beach, California, and starts a new company called Axcom. And you gotta picture this. They set up shop in this generic office park that had actual working oil wells pumping away right in the parking lot. You can't make this stuff up. It was not the high-tech headquarters you might be imagining.
And while they're trying to build this perfectly logical, emotion-free trading system, Oxy is, well, he's a one-man chaos agent. He's running these bizarre weight loss competitions in the office, trying to cheat by eating pounds of melon to add water weight. He sets the microwaves on fire, trying to dry his underwear. I mean, it was a total circus. The irony is just off the charts. But here's the kicker. Even with Strauss's perfect, sparkling clean data, they hit a wall. A huge wall. Their simple models just weren't cutting it anymore. They started getting desperate, trying to find correlations between the markets and everything. Sunspots, phases of the moon, you name it. They were trying to predict coffee prices by looking at Brazilian weather patterns. And nothing was working. They were completely stuck. So Amex finally realizes, okay, the problem isn't the data, it's our math. It's too simple. We're trying to draw a straight line through a system that's pure chaos. They needed a bigger mathematical weapon. They needed someone who was an expert in something called stochastic equations. And that expert's name was René Carmona. Okay, now stochastic equations sounds super intimidating. I get it, but the core idea is actually pretty simple. Think about forecasting the weather. You know you can't predict the exact temperature 2 weeks from now, right? But you can build a model that gives you a probable range of temperatures. That's the basic idea. It's the math of modeling complex, messy systems that have a lot of randomness but aren't totally random. Perfect for financial markets. And this is where the whole story pivots. Carmona comes in, takes a look at what they're doing, and basically says, you're thinking about this all wrong. He had a radical idea. He said, let's stop trying to tell the computer what patterns to look for. Instead, Let's just feed it all of this amazing data we have and let the computer tell us what the hidden patterns are. This was, for all intents and purposes, an early form of machine learning, a real game changer. And what was Jim Simons' reaction? He hated it. He absolutely hated the idea. You can just feel the frustration in that quote. See, the old models, he could understand them. He could look at the math and see the logic. But Carmona's new system, it would spit out a trade, but nobody could tell you exactly why. It was a total black box. And this right here, this is the central conflict of the entire story. The guy who wanted to build a machine based on pure, undeniable logic was now being asked to put his faith in a machine whose logic he couldn't see or understand. It went against every fiber of his being as a mathematician. He lived to understand the why, and this system wasn't giving it to him. But Carmona's response was just perfect. He essentially told him, Jim, you have to get past your need to understand it. Just look at the results. It's not my opinion, it's what the data is telling us. And Axe backed him up. He told Simons, it works, Jim. This was the very thing Simons had set out to create. And now that it was real, he was afraid of it.
But in the end, you just can't argue with the numbers. The data doesn't lie. Once they started using Carmona's new black box approach, the results just took off. I mean, look at the difference here. It's not even a contest. The machine was working, and the performance was so good that Simons had to face the facts, even if it made him deeply uncomfortable.
So they had actually done it. After all the chaotic personalities, the dead ends, the painstaking work on the data, and this huge mathematical leap of faith, they had built a machine that worked. It could find profitable trades all on its own. But for Jim Simons, this was never going to be the finish line. He knew it could be bigger, better, and more powerful. This was just the start. And that's the big question this whole story leaves us with, right? They had successfully built a trading system without human emotion. But in doing that, they had created something else, a system that also worked without human explanation. So it really makes you wonder, how much can you truly trust an intelligence that you can't fully comprehend?
Let's talk about a guy named Elwyn Berlekamp. He was a pure mathematician who honestly looked at the world of finance with total contempt. And yet, somehow, he found himself running one of the most secretive and successful trading firms on the planet. This is a story about a clash of brilliant minds, a really high-stakes gamble, and what happens when you let an abstract thinker play with real money.
And this quote right here, this is the key to the whole thing. To really understand how a man with basically zero interest in getting rich ended up turning Wall Street on its head, you have to get this. For him, the market wasn't about dollars and cents. Not at all. It was the ultimate intellectual puzzle just waiting to be solved.
So how in the world did this happen? Well, here's how we're going to break it down. We'll start with his very unlikely beginnings miles away from Wall Street. Then we'll follow his education in game theory, see his hesitant first steps into trading, and then watch the sparks fly when his ideas collided with another genius at a firm called Axcom. And finally, we'll see what happened after this quiet professor basically staged an intellectual takeover.
To really get a handle on just how much of an outsider Berlekamp was on Wall Street, you've got to go way back to his childhood. We're talking Fort Thomas, Kentucky, and believe me, it was about as far from a trading floor as you could possibly get.
So get this. Berlekamp was the son of a minister, a really serious kid who got way more of a kick out of a math game called Dots and Boxes than, a football game. He looked at organized sports with this kind of mathematical disdain. He just thought they were illogical and that everyone made way too big a deal out of them. He only joined the swim team after calculating the odds, figuring they were so desperate for people they wouldn't dare cut him. And even though he was the slowest guy in the pool, his team was so good that in a state competition, they gave him such a massive lead that even he couldn't lose it. That gold medal taught him a lesson that would define his entire career. You always, always find a way to get on a great team.
And this, right here, tells you everything you need to know about his mindset. When it was time to pick a college, it wasn't about the parties or the prestige. It was a matter of pure principle. He chose MIT for one very specific reason. He heard it didn't have a football team. He was there for one thing and one thing only, the math.
And at MIT, Berlekamp absolutely found his people. He was suddenly surrounded by some of the most formidable intellectual giants of the 20th century. I mean, it was an experience that basically forged his brain in a crucible of pure genius.
As a freshman, can you imagine? He takes a class with John Nash, the guy from A Beautiful Mind,
and actually saw one of the first public signs of Nash's tragic mental decline. Then he goes on to study under Claude Shannon, the father of information theory, wins the toughest math competition in the country, and boom, by 1964, he's a professor at Berkeley. His path was set, and it was purely academic.
So one day, his hero, Claude Shannon, pulls him aside in a hallway. And you'd think, right, they're going to talk about some deep mathematical concept. Nope. Shannon leans in and whispers, "It's not a good time to invest in the market." Berlekamp was just floored. Not just because he was completely broke and had nothing to invest, but because the whole idea of a genius like Shannon messing around with stocks just seemed weird.
And yeah, that moment pretty much sums up his entire view of finance. To him, it wasn't a worthy pursuit at all. It was just a game for rich people, one that created very little of real value for the rest of the world. And it's this deeply held belief that makes the next chapter of his life so unbelievable.
But then, his perspective started to shift, just a little bit, and it happened during his time at Bell Labs. It wasn't some slick trader who changed his mind, but another brilliant scientist, a chain-smoking Texan physicist named John Kelly Jr.
So Kelly had come up with this mathematical formula for betting on horse races, which he'd actually derived from Shannon's own work. And the core idea, the thing that just completely hooked Berlekamp, was that simply picking the winning horse, that wasn't even the hard part. The real challenge, the real intellectual meat, was figuring out how much to bet. If you were really confident and had a big edge, you bet a lot. If you were less sure, you bet less. Now, it sounds simple, but this concept, sizing your bets perfectly based on your advantage, was the seed of a completely revolutionary way to look at trading.
Look, he still had zero personal interest in getting rich from the stock market. Not one bit. But as he talked about Kelly's work, he started to see the parallels between betting on horses and investing in stocks. Chance is a huge factor in both. And for the very first time, he saw finance not as this grubby chase for money, but as a complex, fascinating math problem. The hook was set. Big time.
Okay, so fast forward a few years. A fellow mathematician, you might have heard of him, Jim Simons, invites Berlekamp to consult for his very secretive trading firm, Axcom. It was run by another brilliant but, let's say, difficult mathematician named James Ax. And this is where Berlekamp's abstract theories would come crashing head-on into the stubborn reality of someone else's system.
The tension was there from second one. I mean, can you imagine? That was Axel's first greeting to Berlekamp. No handshake, no welcome, just a flat-out dismissal. Berlekamp had flown all the way from Berkeley only to be told he wasn't wanted. It was a pretty clear sign of the intellectual war that was about to break out.
Their whole conflict, it really boiled down to one thing, a fundamental disagreement about time and risk. On one side, you had Berlekamp. Using the ideas he learned from Kelly's horse racing formula, he wanted to trade way more frequently. He saw a huge advantage in making tons of small, quick bets and sizing them aggressively whenever the model screamed that there was a clear edge. And on the other side, you had Ax. He believed you had to stick to long-term trends. He thought rapid trading was just reckless, expensive, and based on garbage data.
And every single time Berlekamp brought up a new idea, a new suggestion, what did he get? This. We'll get to that. Ax just dismissed everything he said as tinkering. He basically refused to implement any of the professor's theories, and it created this incredibly frustrating stalemate.
Meanwhile, Ax himself was just checking out. He became this virtual hermit, running the firm from his fancy seaside home in Malibu, only bothering to come into the office maybe once a week. He started making trades based on headlines he read in the New York Times instead of the firm's own sophisticated models. And as he disengaged, well, you can guess what happened. The discipline fell apart, and the fund's performance, it went right down with it.
So what do you get when you have a broken strategy and a manager who's never there? You get a disaster, a complete and utter disaster. The simmering conflict and the terrible performance finally boiled over, pushing Axcom right to the edge of total collapse.
By the spring of '89, the fund was in an absolute freefall. I mean, just look at that number, down nearly 30% from its peak. This wasn't just a bad month, folks. This was a total catastrophe, and it sent investors scrambling for the exits. The whole firm was about to go under.
That's when Jim Simons finally had to step in. He sends this letter, and it's a bombshell. He orders an immediate halt to all long-term trading, which was, the very core of James Ax's entire strategy. It was a dramatic move that effectively stripped Ax of all his authority.
And Ax, he was furious, livid.
He saw it as a total violation of their partnership, a betrayal. He threatened to sue, yelling at Berlekamp, "He's been bossing me around too long." But he was trapped, and deep down he knew it.
And this was Berlekamp's moment. But you've got to remember, this wasn't some corporate power grab. For him, it was never, ever about the money. He'd just gotten completely hooked on the intellectual exercise. With Axion backed into a corner, he saw a clear path. His chance to finally run the experiment, to implement his own theories and see if his math could actually solve the puzzle of the market. So he made Axion an offer to buy him out.
So what happened next? Well, Berlekamp's takeover was a massive success. He put his short-term trading strategy into place, and the firm's fortunes turned around dramatically. But the story doesn't end there, because for James Axe, the man who was forced out, this professional crisis actually led to something pretty profound.
This might be the most surprising twist in this entire story. After getting pushed out of finance, Axe went through this incredible personal transformation. He moved to San Diego and started writing poetry. He reconnected with the world of academic math. And, most importantly, he reconciled with the two sons he had abandoned 15 years earlier. When he died in 2006, his tombstone wasn't engraved with the stock ticker, but with a mathematical theorem. He had found his way back to his first love.
The firm that Berlekamp took over would eventually become Medallion, one of the most successful hedge funds in history, and it was all built on his principles of short-term trading. Which kind of leaves us with this fascinating question, doesn't it? In a world that's so driven by the bottom line, can a mindset that's focused purely on solving the puzzle rather than making a profit actually be the most profitable strategy of all? Berlekamp's story suggests it just might be.
All right, let's dive right in. We're going to unpack the incredible story of a math professor who basically went to war with Wall Street's gut instincts. His only weapons? Pure data and a completely radical new idea. This is the professor who tamed the market.
You know, this quote from Brian Keating, it just perfectly captures the heart of this story. It's all about that eternal struggle, right? That tug of war between what the numbers are telling you is true and what your emotions, your gut are screaming at you to do. And that battle is nowhere more intense than in the high-stakes world of finance.
So, let's set the scene. The year is 1989. You've got this brilliant academic who steps into the ring, determined to build the perfect, emotion-free money-making machine. But it turns out the biggest obstacle isn't the chaotic market, it's the very man who hired him to build it.
To really get how wild his idea was, you first have to understand the world he was stepping into. I mean, this was a total clash of cultures. This was academia meets the absolute jungle of Wall Street.
The late 80s on Wall Street, oh man, it was just pure uncut excess. Think Gordon Gekko shouting greed is good. The entire game was about having an information advantage. It was about getting that secret tip, that rumor about a takeover before anyone else. It was a world of huge egos, total aggression, and yeah, sometimes literally briefcases full of cash. And this is what I find so fascinating. On one side, you've got these slicked back hair masters of the universe, and on the other, you have our guy, Elwyn Berlekamp. He was this balding, bespectacled professor who kept 5 different colored pens in his pocket protector and honestly could not have cared less about your hot stock tip. He was the classic absent-minded professor dropped right into the lion's den.
And this professor, he didn't just bring a new set of tactics. He brought an entirely new philosophy, a model so foreign to Wall Street that even his own colleagues back in academia thought he was, a bit of a flake with some pretty ridiculous ideas.
This was it. This was the billion-dollar question, and pretty much everyone on the street was convinced they already had the answer. The thinking back then was you go big. You find what you think is a sure thing, some piece of news that's going to move the market, and you bet the farm on it. You make a few huge, high-conviction trades, and you just pray that you're right. Doing anything else was seen as a total waste of time.
As Berlekamp himself said, it was like an unquestionable truth. But because he was an outsider, he wasn't just skeptical. He thought the whole approach was fundamentally broken. I mean, making just a few big bets, that just magnifies your risk. If you blow it on 1 or 2 of those, you're done. You're completely wiped out.
So here it is. Here was his brilliant, radical idea. He said, let's treat the market less like a series of big strategic chess moves and more like a casino. Think about it. The house doesn't win every single hand of blackjack, right? Of course not. But its tiny, consistent edge Played out over thousands and thousands of hands guarantees it will make a profit. Berlekamp's whole idea was, if you trade a ton, you only need to be right 51% of the time. A tiny edge over and over and over again.
It's a great theory, right? But the whole thing hangs on finding that tiny 51% edge. And that led them on this incredible hunt for what they started calling market ghosts, these faint, almost invisible patterns hidden in the noise of the market. So the team, led by Berlekamp and this other genius mathematician named Henry Laufer, just let the data do the talking. They didn't care why something was happening, only that it happened predictably. And they started finding these weird little quirks, like the weekend effect, where whatever a stock did on Friday, it had a tendency to keep doing on Monday. Or how prices would often dip just before a big government report and then pop right after.
Now, these were not giant, flashing buy signals. They were tiny, statistical whispers in the data. They were so faint and so quick that almost every other investor either couldn't see them at all or just wrote them off as random noise. But for Berlekamp's team, these ghosts, they were pure gold.
And this right here, this table, shows their big breakthrough. Now, according to the efficient market theory, which is the big idea that all known info is already priced into an asset, this shouldn't be possible. The price of something now shouldn't predict its price in the next minute. And look, for stocks, the theory holds up. The correlation is just 1%, basically random. But then look at the currencies. The Deutschmark showed a correlation of up to 20%. That meant if it went up 1 hour, it was shockingly likely to keep going up the next. They had found it. They had found their edge.
So armed with these ghosts, they completely rebuilt their entire trading system. Everything was now short-term, high-frequency, and the results were immediate and absolutely explosive. But the success brought a whole new set of dangers that nobody saw coming.
Just look at that number. After losing 4% the year before, their fund, which was called Medallion, just skyrocketed to a nearly 56% net return. Insane. Their average time holding an investment went from a week and a half down to just a day and a half. Things got so good, they were popping champagne in the office so often, they actually had to make a rule. We only celebrate if we make 3% in a single day. The machine was working.
But then they hit a snag. The model was telling them they should be making a killing trading the Canadian dollar. But in reality, every single trade was losing money. Mathematically, it made 0 sense. But the real world was a lot simpler. They were being cheated. Floor traders in Chicago were seeing Medallion's big orders come in, they'd quickly buy for themselves to nudge the price up a tiny bit, and then they'd sell it to Medallion for a quick, guaranteed profit. It was an old-school Wall Street trick that their brilliant academic models were completely blind to.
And they'd barely even fixed that problem when a much, much bigger one appeared. A rumor, a whisper, that their only brokerage, the firm holding all of their money, might be going bankrupt. And if that firm went down, their entire fund, every single dollar, would be frozen and probably gone forever.
Now, Berlekamp, the academic, he hesitated. It was just a rumor, right? Moving all their money would be a huge pain. But Jim Simons, the fund's founder, he operated on pure instinct. And he said this incredible line to Berlekamp. This wasn't about data. It wasn't about probabilities. This was about survival. So they pulled all their money out immediately. Months later, the brokerage filed for bankruptcy. Simons's gut instinct saved them from total annihilation.
So the fund was safe, the system was printing money, but that success created a new conflict, this time from inside the firm. The battle was no longer against the market, it was between the man who had ordered the machine and the machine itself.
And here we get to the central irony of this entire story. Jim Simons, the man who wanted a purely systematic, scientific, emotion-free trading system, he couldn't keep his own emotions out of it. When the Gulf War kicked off and oil prices were going crazy, he was on the phone constantly telling Berlekamp to override the system and buy gold based on his own gut feelings.
So this created a fundamental clash of philosophies. On one side, you had Berlekamp, the purist. He believes the system was the strategy. You don't mess with it. You trust the math that you spent months perfecting. And on the other side, you had Simons, who saw the system as an amazing tool, but a tool that could still use his experienced hand to, juice the returns a little bit here and there. For Berlekamp, this constant second-guessing, this intrusion of human emotion into his beautiful, logical machine, it just became this psychological grind that was too much to take.
It all came to a head one day.
Simons calls them absolutely buzzing, convinced they could make an 80% return that year. Berlekamp, being more cautious, thought 30% was more realistic. And in that moment, worn down by all the calls, Berlekamp saw his opening in their different expectations. He basically said, "Jim, if you're so much more bullish than I am, if you think this is worth so much more, you should buy my shares."
And Simons did it. He took the deal. So Berlekamp walks away after just 16 months, making 6 times his initial investment. He goes back to teaching at Berkeley, totally convinced that he had just gotten an amazing deal from an overenthusiastic Simons. He later said, "It never occurred to me that we'd go through the roof." And so Jim Simons was left alone with his perfected machine. But it really leaves us with this huge, fascinating question. In our drive to create these perfect, data-driven systems, what happens to the messy, unpredictable, sometimes brilliant human element that builds them in the first place? In his quest to remove all emotion, did Simons accidentally push away the exact kind of skeptical, genius mind that he needed to create the system? And what is the perfect balance between the cold logic of a machine and the intuitive spark of its creator?
Welcome to The Explainer. Today, we're digging into something huge, the quant revolution in finance. But we're not talking about the names you already know. We're going way back to uncover the secret history, the unsung heroes and forgotten pioneers who actually set the stage for all of it, long before the legends of today even entered the game.
All right, let's start with a quote that honestly just nails the theme of our entire story today. This line from Ecclesiastes was the guiding principle for a trader way back in the early 1900s, and it perfectly captures this core idea, that if you want to know the future, you have to look for patterns in the past. It sounds so modern, but you'll see, this idea is as old as the markets themselves.
Okay, so here's what we've got on tap for this explainer. We'll start with the new idea that lit the fuse, then jump way back to its ancient roots. We'll meet some market mystics and momentum kings, see how computers changed everything, uncover a secret Wall Street lab that let a golden opportunity slip away, and finally, we'll see how a huge race was already underway.
All right, Section 1. Let's dive right in. The story really kicks into high gear in 1990 with a mathematician, a guy named Jim Simons, who has this lightning bolt moment, an idea he thinks is going to change the world.
So Simons' big idea was this. You could use historical data, feed it into powerful computer models, and find patterns that would basically let you predict where the market was headed. It's a powerful idea, right? But here's the kicker. Simons, for all his genius in math, knew almost nothing about the history of finance. He had no idea he was walking down a path that was, well, centuries old.
Which brings us to our next section. Let's really wind the clock back and see just how old this idea is. Because this dream of using the past to predict the future, it's not new at all.
I mean, just look at this timeline. This quest goes all the way back to ancient Babylon, with traders literally scratching crop prices onto clay tablets to try and get an edge. Then in the 16th century, you have a guy using astrology, but also, get this, backtesting his signals. In 18th century Japan, Munehisa Hama invents candlestick charts, arguing that human emotion drives the market. And it all leads up to the late 1800s with Charles Dow, who finally brings some real mathematical rigor to the table and basically invents modern technical analysis.
Okay, so fast forward to the 20th century. Computers aren't a thing yet, but that doesn't stop people from trying to chart the markets. And this era, it produced some, let's just say, colorful characters and some absolutely spectacular flameouts.
And this is where it gets really interesting. You've got these two totally different figures. On one hand, you have William D. Gann, this market mystic who talked about a cosmic law of vibration and geometric angles. And on the other, you have Gerald Side Jr., the momentum king of the 60s, who built this crazy war room full of charts to ride the bull market and became a huge star.
But here's the problem, and it's a big one. For all his fame, for all his legendary calls, Gann's actual trading record was never really proven. And when he died, his estate was worth about $100,000. I mean, that's just not the kind of fortune you'd expect from a Wall Street wizard.
And so you see what happened, right? When guys like Gann and Tsai, whose fund got absolutely hammered in the 1970s, when they crashed and burned, it gave the whole idea of pattern-based trading a really bad name. For decades, the Wall Street establishment just laughed it off. They called it voodoo science.
But just as everyone was writing it off, a new tool showed up, a tool that would change absolutely everything. The computer was about to make its grand entrance. And this is when we see the first real quants emerge.
You had Richard Dennis, the Prince of the Pit, who tried to create a system to trade without emotion. He even trained a group of newbies called the Turtles to prove anyone could do it. But even he got wiped out in the '87 crash. The real pioneer, the guy who truly proved this could work, was Edward Thorpe. He was a mathematician who showed, without a doubt, that you could use math and computers to consistently beat the market.
Thorpe's method was just brilliant. He literally took the card-counting strategies from his book Beat the Dealer, the stuff he used to crush casinos, and just applied them to Wall Street. He found the formula to spot when certain assets were mispriced, used some of the earliest computers to make his moves, and the results were insane. His fund averaged over 15% a year for almost 20 years. He saw Wall Street as the world's biggest casino, and man, did he have the winning system.
Okay, so while Thorpe is out there proving this can be done, something else is happening in secret. Deep inside one of the biggest banks on Wall Street, a super profitable little group was forming, and the bank had no clue what a gold mine it was sitting on.
It all started with this one guy, a computer science grad named Jerry Bamberger. He's just building trading software at Morgan Stanley, and he notices something weird. Every time there was a big pairs trade, like selling Coke and shorting Pepsi at the same time, the prices would get out of whack for just a split second, and then they'd snap right back. He saw an opening.
And that one little observation led to this incredibly powerful strategy we now call statistical arbitrage. So think about it like this. You have two stocks that almost always move together, right? Like Coke and Pepsi. If one of them suddenly drops for a millisecond, the computer can jump in, buy the cheap one, sell the expensive one, and just bet on that relationship going back to normal. You're making thousands and thousands of tiny bets that have a super high chance of paying off.
So this new boss comes in, Nunzio Tartaglia, and he turns Bamberger's little project into a full-fledged group called APT, Automated Proprietary Trading. And it just exploded. We're talking about a tiny team trading almost $1 billion a day, raking in $50 million a year for Morgan Stanley.
But here's the twist, and this is so important. The big shots at Morgan Stanley, they were terrified. It wasn't just that they didn't understand how this computer black box was making so much money. It was a culture thing. This was a machine run by physicists and programmers, not star traders with gut feelings. It completely upended the Wall Street pecking order. So the very first time the group had a bad year, in 1988, the executives pounced. They shut the whole thing down. And in doing so, they basically scattered one of the most brilliant quant teams ever assembled out into the world.
And that one decision, shutting down that lab, it basically created the modern quant industry by accident. All that talent flooded out the doors and started their own firms. A brand new race was about to begin, and Jim Simons was about to step onto the track, completely unaware of who he was up against.
Two guys from that old Morgan Stanley team are really key here, Robert Frey and David Shaw. Frey actually left even before the group was shut down because he was worried competitors were catching on. And guess who gave him the money to start his own firm? Jim Simons. But the real force of nature was David Shaw, a brilliant computer scientist who decided to go build his own empire.
Shaw gets $28 million in seed money and starts D.E. Shaw & Co. out of this gritty little office above a communist bookstore of all places. And just like that, he becomes Jim Simons' biggest rival, even though Simons probably didn't even know he existed yet. He built a quant powerhouse almost overnight.
And his hiring strategy was totally out there. Shaw didn't just want math whizzes. He hired brilliant people from everywhere. Philosophy majors, English majors, chess champions, you name it. He believed you needed all kinds of creative thinkers to crack the market's code. And one of his first hires? A young programmer with a really loud laugh named Jeffrey Bezos.
Okay, so let's just take a snapshot of where things stood in 1990. The same year Jim Simons is having his big idea. Simons is running a tiny fund, maybe $25 million, still trying to get his models to work. Meanwhile, David Shaw is already managing hundreds of millions, has over 100 brilliant employees, and is a dominant force in the field. Simons wasn't just late to the party was already in full swing, and he wasn't even on the guest list.
And that just sets up the ultimate cliffhanger, doesn't it? Simons has this incredible idea, sure, but the race has already started. He's way behind these super smart, well-funded rivals who have a massive head start. It really leaves you with a big question. How could a math professor from outside Wall Street possibly hope to catch up?
Welcome back to The Explainer. Today we're jumping right into a story that honestly changed finance forever. We're talking about Jim Simons and how he and this small group of mathematicians started to, well, basically crack the code of the market.
So picture this. It's the early 90s. The idea of a black box, some mysterious computer algorithm making trades, Wall Street thought it was a complete joke. I mean, these guys were making fortunes the old-fashioned way, right? With gut feelings, research, a lot of bravado. And this quote on screen, it pretty much sums it all up. The thinking was, what do these math geeks know about our business? Jim Simons and his team weren't just outsiders. They were seen as playing with fire.
All right, so here's what we're going to cover. We'll start with the struggle to even get noticed, then meet the genius team that came together. We'll dive into how they actually cracked the code, how they ended up trading human psychology, and then get into the growing pains and the personal tragedy that came with all that incredible success. Okay, let's dive into section 1. The year is 1991. Jim Simons has been at this for a decade, and he's still basically fighting for every single dollar, trying to convince a world that just doesn't get it that his math-based approach is the future. Yeah, even though Simons had completely overhauled his models and felt like he was finally onto something big, he was just getting doors slammed in his face. It's wild. He goes to one of his very first investors, a guy named Donald Sussman, and he's all confidence, like, now I really have it. We've had a breakthrough. But Sussman, he just shuts him down. He says, I'm sorry, but I already have David, talking about David Shaw, another quant who was already way bigger. It was just this constant, brutal, uphill battle. So Simons realized pretty quickly he couldn't take on Wall Street by himself. The only way forward was to find partners who could see the world the way he did, who could see the patterns in the noise, even if they came from totally unconventional places. He didn't just need a team. He needed a team of absolute, undeniable geniuses. And boy, did he find them. First up, you've got Henry Laffer, a brilliant mathematician known for being super collaborative, a really calming presence, which was a huge change from some of Simons' earlier, more difficult partners. And then there's Nick Patterson, a former codebreaker for the British government who was so skeptical of Medallion's profits that his first thought was, this has to be a scam, maybe some kind of money laundering thing. I mean, Patterson's suspicion was no joke. For his entire first month on the job, he was running his own secret audit. Can you imagine? He'd write down all of Medallion's closing prices at the end of the day, and then he'd go home and meticulously check every single one against the Wall Street Journal. It was only after he proved to himself that the numbers were real that he finally let his guard down and actually started doing the work. Okay, so with the dream team of Laffer and Patterson now in place, they were finally ready to take on their real mission, to actually, for real, crack the market's code. And the first huge breakthrough, it came from Henry Laffer. See, back then, most people looked at the market in these big, clumsy chunks, like what happened during the day and what happened overnight. Laffer had this totally revolutionary idea. He said, what if we carve the day up into hundreds of tiny little pieces, specifically 5-minute segments? This idea, it changed everything for them. So by zooming in on these 5-minute bars, they suddenly started seeing these hidden patterns, these little glitches in the matrix that they called non-random trading effects. Now, these weren't some grand theories about the global economy. They were small but statistically significant oddities. Like, for example, they found that what happened in the market on a Friday morning could predict, with this almost spooky accuracy, what would happen later that same afternoon. It was like they were putting the market under a microscope for the very first time. But finding a signal that pointed to profit, that was only half the battle. The other half was actually making the trade. Every time they bought or sold, their own actions could push the price against them, basically eating away at their potential gains. This problem, the slippage, was their absolute biggest enemy. They were so obsessed with it, they even gave it a name, the devil. And taming the devil became just as important as finding the next signal. All right, so let's talk about the results. Medallion's returns started going into just unbelievable territory. I'm talking a 71% surge in 1994 alone. And as the money poured in, the team couldn't help but ask themselves this really fundamental question: why is this working so ridiculously well? Yeah, this became the big mystery at the heart of it all. People often think of financial markets as a zero-sum game, right? For every winner, there has to be a loser. So if Medallion was just consistently printing money day after day, who was on the other side of their trades? Who was losing all that cash? So Nick Patterson, the skeptic, goes and asks Henry Laffer this exact question. And Laffer's answer was just so short, so blunt, and honestly, kind of profound. He said their profits were coming from a lot of dentists. And what he meant by that was it was his shorthand for all the amateur, overconfident traders out there who thought they could outsmart the market, trading way too often on hunches. And here's what's so wild. Simons and his team, they weren't economists. They were mathematicians and programmers. But they had accidentally stumbled upon the core ideas of a whole new field that was just emerging, behavioral economics. They figured out that markets weren't these perfectly rational, efficient machines. No, they were driven by people. And people? Well, people are predictable. They make the same mistakes over and over. Their system, their black box, was basically built to systematically exploit these very human biases. It was designed to capitalize on things like loss aversion. You know, that psychological quirk where the pain of losing a dollar feels twice as bad as the pleasure of gaining a dollar. It causes people to panic and sell at the absolute worst time. As one researcher put it, they realized they weren't really modeling the market. They were modeling human behavior, and they learned to take advantage. But you know how it goes. This kind of incredible paradigm-shifting success, it created a whole new set of massive problems. The firm was almost becoming a victim of its own genius, and the pressure was really starting to build. And those tensions, they just shot up really fast. By '93, the fund got so big that Simons started worrying their own trades were moving the market. So what did he do? He closed it to all new investors and made the whole operation hyper-secretive. Then, in 1995, a buyout offer from a big Wall Street firm, Paine Webber, completely fell apart because they figured out Paine Webber didn't want their secret sauce, their algorithms, they just wanted their client list. And this all kind of came to a head in '96 when a key partner, Sandor Strauss, quit after a huge fight over Simons' decision to move everyone out to Long Island. Really, at the heart of all this conflict was just Jim Simons' raw ambition. You had partners like Strauss who were saying, hey, let's just keep the fund small, rake in these insane profits, and enjoy life. But Simons, no way. He was relentless. He always wanted to do more, get bigger, build a real legacy. As one staffer complained to another, emperors want empires. So while Simons was chasing this professional empire, building this incredible machine to predict the unpredictable, his own life was about to be completely shattered by a tragedy that no model, no algorithm could ever see coming. It was a September afternoon in 1996. His son, Paul, who was this amazing endurance cyclist, was just out for a ride on a road he knew like the back of his hand, right near his childhood home. And in this just random, senseless, tragic moment, a driver backed out of a driveway and hit him. Paul was killed instantly. He was 34. The loss was, as you can imagine, absolutely devastating for Jim and his wife, Barbara. For weeks, Simons just completely disappeared from work. He was a shell of himself. And as Barbara would say later, in this heartbreakingly simple way, you never get over it, you just learn to deal with it. So when Simons eventually did come back to the office, his friends and colleagues could tell he needed something. He needed a distraction, a problem so big, so all-consuming, that it could occupy his mind. And so he refocused all of that energy on the one giant puzzle his team had never quite managed to solve, the stock market. That became his final great challenge. And it really leaves us with this powerful question, doesn't it? After you achieve unimaginable success, and then you suffer an unbearable loss, what really is the true price of that kind of ambition? You know, in the world of high finance, there's this constant tug of war. On one side, you have the human story, the gut feeling, that brilliant flash of insight about a company's future. And on the other side, just cold, hard, emotionless numbers. Well, today, we're diving into the incredible story of a man who bet everything on the numbers at a time when stories were king. And look, Nobel Prize winner Daniel Kahneman, he absolutely nailed the conventional wisdom of Wall Street with this quote. For decades, this was just how it worked. But what happens when someone decides to just flip that entire idea on its head? What if you could build a system where decisions were only made because of a number, completely stripped of any human story? Well, that is the revolutionary, almost crazy idea that one man would build his entire empire on. All right, so here's our roadmap. We're going to start by setting the scene in the early 90s, a world totally run by master storytellers and these gutsy savants. Then, we'll meet our guy, Jim Simons, and the huge scientific problem that nearly sank his whole firm. We'll see how his desperate search for an answer led him to some very, very unlikely recruits. And finally, we'll see the dawn of a new renaissance in finance.
Okay, let's fire up the time machine and head back to the early 1990s. This was, without a doubt, the golden age of what's known as fundamental investing. I mean, really think about it for a second. The idea of letting some computer pick stocks for you, people would have laughed you out of the room. It sounded like something out of a sci-fi movie. The real power players were human. They ran on instinct, on decades of experience, on pure street smarts. This was a world where legendary investors were treated like absolute rock stars, and their brains were seen as the ultimate market-beating weapon.
And no one, and I mean no one, embodied this era more than Peter Lynch. He was the manager of Fidelity's Magellan Fund, a true celebrity. And this number right here, this tells you why. An average of 29% in annual gains for over a decade. That is just mind-blowing. He wasn't just beating the market, he was completely rewriting what people thought was even possible.
So what was his secret sauce? Well, Lynch's whole philosophy was almost shockingly simple. He argued that everyday folks, people like you and me, could actually outperform the pros just by paying attention to the world around them and investing in companies they really truly understood. No complex algorithms, no fancy computers, just good old-fashioned common sense and putting in the work. And this story just perfectly brings his strategy to life. It all started with Leg's pantyhose. His wife mentioned how much she liked them, so he starts digging a little, and he notices they're being sold in supermarkets, not just the fancy department stores, which was a brilliant distribution move. He even did his own R&D, buying dozens of pairs of a rival brand and having his employees test them out. By following this simple, real-world logic, he turned a casual conversation about pantyhose into a tenfold gain for his fund. Incredible.
This really gives you a feel for just how old school his methods were. His most powerful tool wasn't a computer terminal, it was a telephone. He was an information bloodhound, a real detective. Sure, he'd call up CEOs, but the real magic was in the details. He'd fly out to visit a company, chat with a cab driver on the way in to get a feel for the local economy, and then he'd eat in the employee cafeteria to discreetly ask the waiters if morale seemed high. It was all about piecing together that human story.
But Lynch's meticulous, story-driven style wasn't the only game in town. There was another breed of investor making huge headlines, the macro traders. These were the guys making their fortunes on a few massive, high-stakes bets. On one hand, you had Bill Gross, the so-called bond king, who mixed mathematical models with a huge helping of personal gut feeling to predict where interest rates were going. And then you had the real gunslingers, the macro guys like George Soros and Stanley Druckenmiller. These guys weren't making hundreds of little investments. Nope, they were looking at the entire global chessboard, trying to get way ahead of huge political and economic shifts, and then, when they were sure they were right, they bet the farm. And this right here, this was their masterpiece. When the Berlin Wall fell, most investors freaked out about Germany's economy. Druckenmiller saw a different story, and he made this huge winning bet on the German currency. But the absolute legend is their 1992 trade. Druckenmiller spots a weakness in the British pound and wants to bet against it. Soros doesn't just agree, he tells him to go even bigger, famously saying trades like this only come around once in a generation. They shorted $10 billion worth of the currency, and in a single day made over $1 billion. Let that sink in. $1 billion in 24 hours. It was just pure, unadulterated conviction. So here's the really crucial point. This was the world of finance. It was dominated by these larger-than-life personalities who ran on human intelligence, on compelling stories, and on just sheer nerve. And into this world walked a quiet mathematician named Jim Simons, who believed he could beat them all without any of that. So how exactly was Simons planning to take on this world? Well, his firm, Renaissance Technologies, had already figured out how to use computers to trade things like commodities and currencies. But stocks were a totally different beast, and their system just was not working. So, the team's strategy was called reversion to the mean. The basic idea is that if two related stocks, let's say Apple and Microsoft, usually trade in a certain pattern, and one day they break that pattern, the system would place a bet that they'll eventually snap back to normal. It would buy the one that fell too much and sell the one that rose too much. Sounds pretty logical, right? The problem was, it just wasn't making any real money. And this quote from our source material captures the problem so perfectly. The model itself was brilliant. The recipe was delicious. It was great at identifying profitable trades. But something kept going wrong in the execution phase. The system would get spooked by small market moves and close out positions way too early, leaving huge profits on the table.
They could see the money right there, but they just couldn't seem to grab it. And you can just imagine the pressure building inside the firm. People were getting so frustrated. The other trading groups were just printing money, while the stock project felt like it was stuck in quicksand. Staffers started openly questioning the project leader, Robert Frey, wondering if this whole thing was just a colossal waste of time. The dream of conquering the stock market with math, it was on life support. But Jim Simons was not the type to give up. He was convinced the answer was out there. It just wasn't anywhere on Wall Street. And as it turned out, the solution would come from a group of brilliant and, maybe more importantly, deeply unhappy geniuses. This quote was the absolute core of Renaissance's bizarre and brilliant recruiting strategy. They went out of their way not to hire people from finance. Instead, they hunted for pure brainpower: academics, codebreakers, scientists, mathematicians. Their recruiter, Nick Patterson, figured, hey, we can teach a smart person about markets, but you can't teach a finance guy how to be a genius. And he had a secret weapon. He loved to poach brilliant people who were absolutely miserable in their current jobs. And that's exactly where he found his next big hire. After reading about some cost-cutting going on at IBM, Patterson had the stroke of genius. He knew their speech recognition team was doing revolutionary work that was conceptually almost identical to what Renaissance was trying to do: find faint, predictive signals hidden inside mountains and mountains of noisy data. And here is the huge mental leap. The old way of teaching a computer a language was to feed it rules. Grammar, syntax, all that stuff. The IBM team did the exact opposite. They just drowned the computer in data, endless hours of recorded speech and text, and they let their program learn the patterns on its own. It's kind of like your phone's autocorrect, right? It doesn't understand what you're trying to say, but based on billions of examples, it can make an incredibly accurate guess about what word you'll type next. And that's why the light bulb went off. What if you could do the same thing with the market? And this is where the story gets almost unbelievable. The key mathematical tool the IBM team was using, the engine behind their whole system, was called the Baum-Welsh algorithm, and it was co-developed by a mathematician named Lenny Baum, the very same man who was Jim Simons' first partner when he started his firm. The solution to Simons' biggest challenge was rooted in the work of his very first collaborator. I mean, you just can't make this stuff up. Convinced this was no coincidence, two key members of that IBM team, Robert Mercer and Peter Brown, finally decided to take a huge leap of faith and join Simons' strange little hedge fund, bringing their revolutionary ideas with them. And what a pair they were. Mercer was the definition of the quiet, eccentric coder. He barely spoke a word, loved working alone, and had these odd quirks like eating his potato chips in ascending order of size. Brown was his polar opposite: loud, energetic, charming, but also fiercely impatient and intellectually aggressive. Their lab at IBM had a culture of no-holds-barred intellectual combat, and Brown was its undisputed champion. They were the ultimate odd couple, and they were about to change the world of finance forever. So here's the setup. You have these two brilliant, clashing personalities arriving at Renaissance just as its most important project is about to fail. They were convinced that their data-driven approach from speech recognition, treating the market not as a story but as a language to be decoded, was the answer. But their system wasn't quite complete. For the final true breakthrough, they would need help from one more brilliant mind from their old IBM lab. The question is, who was it, and how would they finally crack the code? All right, this is one of those stories that honestly sounds like it's straight out of a Hollywood movie. It's all about insane, high-stakes finance, some of the most brilliant minds on the planet who are about to fail, and the one new guy who just might be the only one who can save them all. So I want you to picture this. It's 1995. We're talking about Renaissance Technologies, this super secretive, genius-level hedge fund. And it's bleeding cash. Their brand new revolutionary trading system, it's completely broken. And their only hope, believe it or not, is this junior programmer that pretty much everyone on the team has already written off as a total joke. So, who is this guy? Well, let's meet him. His name is David Magerman. He shows up for his interview in the fall of '94. And look, on paper, this guy is a shoo-in. He is exactly what they need. But in person? Well, let's just say reality was a little bit different. And here's where it gets interesting. You have to understand the disconnect. Renaissance, right, it's packed with these PhD mathematicians, absolute geniuses, but they didn't have the hardcore coding skills to actually build their crazy complex systems. Magerman was a coding expert,
And his old bosses from IBM, Peter Brown and Robert Mercer, were now big shots at Renaissance, and they vouched for him. But the interview itself, was a total train wreck. He came across as arrogant, immature, and with his baby face, people literally said he looked like an overgrown boy. The only reason, and I mean the only reason he got the job, was because Brown and Mercer basically put their foot down and said, look, we desperately need his skills. Now, to really get what happens next, you gotta get inside this guy's head. Magerman had spent his whole life just craving approval, especially from his dad, who was pretty distant. He was desperate for praise from teachers, from coaches, anyone in charge. I mean, at one point, he practically starved himself just to become a long-distance runner, all in the hopes of getting a single compliment from his father. This deep, deep need to prove himself, to be the one who rides in and saves the day, he even calls it a messiah complex. And that complex is the engine that's going to drive everything he does at Renaissance. So Magus Sherman finally starts in the summer of 1995, and he walks into a place that, well, it doesn't really feel like a high-tech hedge fund. The offices are kind of drab, the furniture looks like it's from a garage sale, and the legendary founder, Jim Simons, is just walking around in Bermuda shorts. But hidden underneath all that casualness was a massive billion-dollar problem. The heart of the whole crisis was this brand new stock trading model they called Nova. Now, on paper, the strategy was pure genius. It should have been an absolute money-printing machine. But in the real world, it was a total dud. It was, as the founder Jim Simons put it, just limping along. It was failing badly. And Robert Mercer, the brilliant and super quiet guy who hired Magerman, he summed up the whole problem with this old proverb. So what does that even mean? Well, what he was saying is that the system was coming up with fantastic trading ideas, that's the cup, but something was going horribly wrong during the execution, in the process of actually making the trades, that's the slip, before the cup ever reaches the lip. The theory was perfect, the practice was a complete disaster. And this is basically how it all fell apart. It was a domino effect. So the Nova system would spot a great trade. Awesome. But then, for some practical reason, it couldn't actually do the trade. Maybe the stock wasn't available to short, or they hit their borrowing limits. And because the whole system relied on this perfect, delicate balance, just one missed trade would throw the entire portfolio's risk out of whack. And once that happened, the model itself was compromised, which then led to a cascade of even more bad decisions. It was a complete and total vicious cycle. So, into this pressure cooker walks David Magerman, the guy who's desperate to prove everyone wrong. And he cooks up this plan to make himself absolutely essential. And at first, it works a little too well. His strategy was honestly kind of brilliant and also totally self-serving. He goes around and convinces everybody that they have to upgrade their programming language from C to the much more advanced C++. He's telling these world-class mathematicians that C is so 1980. Of course, the real reason he's pushing this is that he just happens to be the only expert in C++ in the entire firm. And the plan was a runaway success. All of a sudden, you have these towering figures in mathematics, these legends literally lining up at his desk, begging the new kid for help with their code. Just like that, he was indispensable. He became their pet, especially to his boss, Peter Brown, who was finally giving him all the praise that he had been craving his whole life. So he's feeling pretty good about himself, maybe a little too good, and he decides it's time to pull out his secret weapon. It's a program he wrote back at IBM called Joshua, which he named after the supercomputer in the movie War Games. It's a script that monitors a computer network. He figures, hey, this is just another way I can show off and help the firm. He could not have been more wrong. Magerman runs his unauthorized program right in the middle of a trading day, and almost instantly the entire network crashes. His little script unleashed a virus. In one single moment, he goes from being the team's favorite pet to its biggest liability. Peter Brown, the guy who had been praising him, storms over, his face red with fury, and just screams this at him. A few weeks into his dream job, Magerman was a complete and total outcast. And to make matters 1,000 times worse, Magerman's epic blunder could not have come at a more terrible time. Just as he's being shunned by everyone, the trading system is diving deeper and deeper into this inexplicable losing streak. The pressure on the team was building to a breaking point. And with the system failing, the knives started to come out. The firm's really successful futures traders, the old guard, they started pointing fingers at Brown and Mercer's team. They were whispering that the problem was these new computer guys. The whole atmosphere was just toxic. Everybody knew something had to give. And then
it happened. The founder, Jim Simons, finally had enough. He walked in and gave Brown and Mercer an ultimatum. You have 6 months. 6 months to fix this broken stock trading system. And if you can't, I'm shutting the entire project down. Their careers, and honestly, the future of the whole firm, were on the line. So now the team is in full-blown crisis mode. I mean, Peter Brown is literally sleeping on a Murphy bed in his office. Mercer is intensely focused. Everyone is on edge. And meanwhile, you've got the outcast, David Magerman, just watching from the sidelines, aching to help. He just knew if he could find the solution, he could redeem himself. So completely on his own, without anyone asking him to, Magerman starts hunting for the bug. He didn't really have much of a life outside of work anyway, so he basically just moved into the office, working day and night, just combing through 500,000 lines of code, desperately looking for that one tiny thing that all these geniuses had somehow missed. And then one evening, his eyes totally blurry from staring at the screen for hours, he spotted something. It was just a little anomaly, a single line in a piece of simulation code that it didn't look right. The line of code had a value in it for the S&P 500 stock index, but it wasn't a variable, something that updated with the live market. No, it was a static, hard-coded number, a number from 1991. For 4 years, the entire simulation had been running all of its calculations based on an S&P 500 value that was literally half of what it should have been, throwing every single result completely out of whack. He was so excited he could barely contain himself. Magerman races to tell Peter Brown. But Brown, who still just saw him as the kid who crashed their whole network, was super skeptical and basically just blew him off. Magerman's heart just sank. But then he figured, you know what? I have nothing left to lose. He took his findings to the other boss, the quiet but formidable Robert Mercer. Mercer, being Mercer, didn't say much. He just sat there, hunched over his computer, patiently checking the code. He grabbed a pencil and a piece of paper, scribbled down from calculations. For about 15 minutes, there was just total silence. Then he put the pencil down, looked up at Magerman, and said just 2 words. "You're right." And that was the turning point. Mercer goes to Brown and convinces him that Magerman, the kid, had found the fatal flaw. But when they presented the solution to the rest of the team, they were met with laughter, total disbelief. You can just imagine it, right? The kid who almost destroyed the firm is now its savior? Yeah, right. Nobody bought it for a second. But Brown and Mercer ignored all the doubters. They implemented Magerman's fix, and the results were immediate. They were undeniable. The system started making money, instantly. That long, painful losing streak was finally over. And David Magerman, he finally got what he'd been searching for his entire life, a cherished pat on the back from his boss. At the very next firm-wide meeting, the founder, Jim Simons, was absolutely beaming. His voice just boomed across the room. This is great. Let's keep it going. The crisis was over. And a brand new era for Renaissance Technologies, one that would make it the most successful hedge fund in history, had just begun. It is just an incredible story when you think about it. One junior programmer, kind of driven by his own personal issues, finds a single tiny error in 500,000 lines of code and literally changes the entire course of financial history. And it really makes you wonder, doesn't it? What small, critical details are hiding in plain sight in our own work, just waiting for somebody to find them? All right, let's jump right in. Today, we're cracking open The Man Who Solved the Market to talk about Renaissance Technologies. This is the hedge fund that's so secretive, so wildly successful. People have basically called it a cult. We're going to zero in on one specific moment, a crisis that almost brought the whole thing crashing down. So this is the big one, right? How in the world do you build a machine that can actually outsmart the market? I mean, this was the question that completely obsessed Jim Simons and his whole team of, well, let's just say brilliant but very eccentric quants. It wasn't enough for them to be smart. No, they had to build a system that was smarter than them. So what does that even mean? And here's where it gets really interesting, because the answer wasn't some secret, complicated formula. Nope. For Simons, the key was culture, specifically a culture of radical openness, and this is the crazy part, a willingness to just embrace patterns that you can't explain, trusting the data even when your gut says, why?
And believe me, that philosophy was about to be tested in a huge way. Okay, so let's set the scene. The year is 1997. On the surface, Renaissance's Medallion fund is just killing it. But behind closed doors, things were getting a little tense. That amazing money-making machine they built, yeah, it was starting to sput. And just to give you an idea of the scale we're talking about, by the summer of 97, Medallion was managing over $900 million. I mean, they were an absolute powerhouse, using these incredibly complex models to trade pretty much everything under the sun. Commodities, currencies, you name it.
But, and it's a big but, there was a problem. Even with all that money and all that success, the magic was starting to fade. The incredible, mind-bending returns they were used to were, well, they were slipping. And for a guy like Jim Simons, that was more than just a problem. It was a full-blown crisis.
Okay, just look at these numbers for a second. In 94, they pulled in a 71% gain. That is just insane. But then look what happens. The next year, it's 38%, then 32%. And by 97, it's down to 21%. Now, for you or me or pretty much any other fund on the planet, a 21% return is a reason to pop the champagne. But for Simons, this trend was a giant flashing red light. It meant they were losing their edge. So what do you do when your genius system starts to fail? Well, Simon's first move was actually surprisingly normal. He basically started a book club for quants. He got his top guys, Peter Brown, Bob Mercer, all of them, in a room to just tear through academic finance papers, hoping they'd find some secret sauce hidden in all that theory. Spoiler alert, it was a complete and total bust. The strategies they found in all those papers, they just didn't work when they actually tested them. The only thing they really got out of the whole exercise was a deep, deep skepticism for so-called experts. It just hammered home one of their core beliefs. All those stories you hear on the news explaining why the market did what it did, it's mostly just noise. The only thing that matters is the data. So, if the answer wasn't in some academic paper, where was it? Well, it forced them to look inward, back at the one thing that truly made them different from everyone else on Wall Street. Their secret weapon wasn't a formula. It was their culture. And this culture was built on three absolutely crucial pillars. First, radical openness. No secrets, no private projects. Everyone saw everything and was expected to challenge everything. Second, they had one single monolithic trading system. Think of it like one giant code base that everyone, and I mean everyone, from the summer intern to Jim Simons had full access to. And third, and this is maybe the most brilliant part, shared success. Your bonus had nothing to do with how your project did. It was based entirely on how the whole fund performed. This forced everyone to pull in the same direction. Now, to understand just how revolutionary this was, you have to appreciate the kind of people he was hiring. There's this old joke, right? How do you spot an extroverted mathematician? They're the ones looking at your shoes when they talk to you. Simons was taking these incredibly brilliant, often deeply introverted people and forcing them to collaborate. It went against their very nature, but he knew it was the only way to build something bigger than any one individual. And the result was this environment that was completely obsessed with solving the problem, not with getting rich. I mean, you had these guys, literal geniuses with PhDs, becoming multi-millionaires, and they're still driving beat-up old cars to work. There's a great story where someone asked if anyone flew first class, and one of the mathematicians kind of sheepishly admitted he did, but only because his wife made him. It was all about the puzzle, not the paycheck. Okay, to really understand why Renaissance's approach was so special, you have to look at the other giant in the room at the time. While Simons and his crew were quietly doing their thing, the rest of Wall Street was completely obsessed with this other firm, Long-Term Capital Management, or LTCM. These were the guys with Nobel Prize winners on staff, and they were absolutely convinced they had solved the market. And the difference between these two firms, it's just night and day. Look at this. LTCM, they thought their models were reality. So when a trade went bad, they didn't question the model. They just threw more money at it, assuming the market would eventually come to its senses. Renaissance was the complete opposite. They knew their models were just flawed guesses about reality. So when a model started losing money, their system was designed to automatically cut the risk. It's a fundamental difference in humility, and it would make all the difference.
And in the summer of 1998, that humility was put to the test. Russia defaults on its debt, a black swan event that LTCM's models said was basically impossible. And poof! They lost over $500 million in one single day. A few weeks later, the firm that was literally run by Nobel laureates, the firm that was too smart to fail, was in such a death spiral that the Federal Reserve had to step in and orchestrate a bailout to prevent it from taking the entire global financial system down with it. This quote from an old-school trader to LTCM's founder, it just says it all. Their models were brilliant, sure, but they missed a basic, brutal fact about markets. When you start bleeding, the sharks can smell the blood in the water, and they will come for you. All those beautiful, elegant formulas, they meant nothing in the face of raw panic. So, the implosion of LTCM was a huge warning shot for the entire industry. But just 2 years later, it was Renaissance's turn to face the fire. The year is 2000. The dot-com bubble is stretched to its breaking point, and it's about to pop and take Renaissance's system down with it. And then it happened, March 2000. The music just stopped. The NASDAQ, which had been shooting for the moon, suddenly slammed into reverse and went into an absolute freefall. And the terrifying thing for the guys at Renaissance was, for some reason they could not figure out, their fund was going down right along with it. On day one of the crash, the Medallion fund lost $90 million. Let me say that again, $90 million. To give you some context, their worst day ever up to that point was a $5 million loss. This was unimaginable. The system was just bleeding money. And it didn't stop. The very next day, bam, another $80 million gone. In just a couple of days, they were staring at losses closing in on $300 million. The machine was completely out of control, and real, genuine panic was starting to creep in. People were just walking around the office in a daze. And this question, it just perfectly captures the desperation of that moment. You have Peter Brown, one of the top guys, going to his boss, Jim Simons, looking pale, hasn't slept, and he's basically just asking, what do we do? The system he helped build was failing spectacularly, and he was completely lost. So this is the moment. This is what would become the stuff of legend on Wall Street. With his fund on the brink of total collapse, Jim Simons had a choice to make. Do you hit the kill switch and override the machine, or do you trust the very system that seems to be destroying you? And that was his answer. While everyone around him was absolutely freaking out, Simons was the calm in the eye of the storm. His command was simple. Trust the model. We let it ride. We don't panic. He was basically saying, look, we built this thing for a reason. If we abandon it now, what was the whole point? So after some absolutely frantic, sleepless nights of digging through the code, they found it. The culprit. It was a momentum signal. See, the system had learned during the bubble that buying tech stocks that were going up was a great way to make money. The problem was, now that those same stocks were in a nosedive, the algorithm was just following its programming. It kept buying them all the way down. Once they found that toxic little piece of code and cut it out, the bleeding stopped almost instantly. And the result of all this? After staring into the abyss, on the very brink of complete disaster, did they just recover? No, they absolutely soared. By the end of that same year, 2000, the Medallion Fund finished up, wait for it, 99%. It's just an unbelievable comeback. They didn't just survive. They became legends. Which brings us to a really fascinating question, and one that feels more important today than ever before, right? Renaissance built a machine that was, in many ways, smarter than they were. It could see things they couldn't. They put their faith in it, and that faith almost destroyed them, right before it made them legendary. It's this incredible story about both the huge promise and the terrifying risk of building things that are smarter than we are. Welcome to The Explainer. Today, we're going to pull back the curtain on a really pivotal time inside one of the most secretive and successful hedge funds ever, Renaissance Technologies. We're talking about the unstoppable, data-hungry machine at its very core. All right, so we're going to break this down into 5 parts. It's a story that traces how this, brilliant machine for making money was almost completely broken by the very people who built it. We're going to see the deep cracks that started to form under the sheer pressure of just unimaginable success. Okay, so let's set the scene. We're starting back in 2001. This is a time when Renaissance's whole mission, their entire reason for being, became this just
insatiable quest for information. It was like they wanted to digest the entire world and turn it all into signals that could predict the future. And this right here, this simple phrase from Robert Mercer became the firm's mantra: there's no data like more data. And you gotta understand, this wasn't just some motivational poster on the wall. No, this was an operational directive. It pushed them to collect a terabyte of information every single year. I mean, that is a truly staggering amount for the early 2000s. They had to buy all this expensive new hardware just to store and analyze the stuff.
So what was the goal here? Well, they wanted to predict an investment's price at pretty much every point in the future. We're talking 3 seconds from now, 3 days, 3 months, you name it. So they just collected and quantified everything. I mean, literally everything. A random news story about a bread shortage in Serbia? Yep, their computers would dig through history to see how markets reacted to stuff like that. They even found something as simple as counting how many times a company was mentioned in the news had predictive value. It didn't even matter if the story was good, bad, or just a rumor. Wild, right?
But the real key insight, the secret sauce, was how they framed the problem. You see, a lot of the top minds at Renaissance, guys like Mercer and Peter Brown, they came from IBM's speech recognition team. So for them, the stock market wasn't a financial system. No, they saw it as a language problem. Think about it. The goal is exactly the same. You're trying to digest this big jumble of uncertain information and make a really good guess about what comes next. Whether it's the next word in a sentence or the next price of a stock, the logic was the same.
And the results? Well, they were just staggering. In 2000 and 2001, you had the S&P 500, the whole market just completely flat. Rival funds were struggling to stay afloat, and Medallion, they delivered average returns of over 65%. It was insane. Their system just churned out these enormous gains with almost no volatility. It really seemed like they had found the holy grail of investing, something totally disconnected from what was happening in the rest of the market.
But here's the thing. Their success wasn't just about the data. It was supercharged by a brilliant and deeply controversial financial tool that let them amplify their bets and manage risk in a way that, frankly, no one else could touch.
So at the heart of their whole strategy was this thing called basket options. Now, these weren't a brand new invention or anything, but the way Renaissance used them, the scale, the sophistication, it was totally revolutionary. It was basically a clever way to control huge portfolios of stocks without actually owning them, without having them on their books. And the process itself was just an engineering marvel. All day long, Medallion's computers are firing off automated instructions to their partner banks. We're talking Deutsche Bank, Barclays. Sometimes they were sending an order every single second. So the banks were the legal owners of the stock, but make no mistake, Medallion was in control. And here's the really crucial part. If the market completely collapsed, the most Medallion could possibly lose was the premium they paid for the options. The banks, though, they were facing billions in potential losses. One guy on staff was so blown away by how good the terms were, he literally moved most of his life savings into the fund. This whole structure gave them just immense leverage. So think of it this way. Their competitors might control, say, $7 of assets for every $1 of their own cash. Medallion, they controlled $12.50. And when they saw what they called juicy opportunities, like the market downturn in 2002, they could crank that leverage up to almost 20 to 1. It was like putting the entire portfolio on steroids. And if that wasn't enough, this structure also created a massive tax advantage. It was kind of brilliant in a way. Because the options were held for over a year, Renaissance could argue that all the profits were long-term gains, which are taxed at a much, much lower rate. But here's the catch. The actual trades happening inside those baskets, they were happening over days, sometimes even hours. It was a loophole, a big one, that would eventually get them into a multi-billion-dollar fight with the IRS. But inside the firm, this whole thing, it caused some real discomfort. You have to remember, Renaissance was built by academics, right? These were people who saw themselves as pure scientists, just discovering fundamental truths in the market. This tax stuff felt different. It was the first real sign of a crack in their culture, this feeling that the relentless pursuit of profit was starting to overshadow the purity of the research.
So this incredible success, amplified by all this clever financial engineering, well, it brought a tsunami of wealth that completely, utterly transformed the lives of these former academics. It created this whole environment of opulence that became known, pretty fittingly, as the Renaissance Riviera.
And suddenly, the signs of all this new money were just everywhere. The parking lot starts filling up with Porsches and Mercedes. One staffer even builds this little widget for everyone's computer screen so you could see a running tally of your personal profits ticking up in the corner of your screen all day. There's this great story where Jim Simons overhears some researchers complaining about their huge tax bills, and he just fires back, "Well, if you didn't make so much money, you wouldn't pay so much in taxes."
And this little quote here, it just perfectly captures the new tensions that we're building. You had Peter Brown, who was trying to shield his kids from all the wealth, driving a Prius, wearing clothes with holes in them. But then, after a visit to Robert Mercer's absolutely massive mansion, his young son gets really confused. He asks his dad, "Don't you and Bob do the same thing?" I mean, they did the same job, so why the huge difference in lifestyle? You could just feel the anxieties and the jealousies starting to simmer right below the surface.
And as all that money and power started to consolidate around this new, wildly successful stock trading group, that jealousy, it started to harden into a really deep cultural rift. The firm that was once this unified academic paradise, it began to literally tear itself in two.
It was like you had two completely different worlds inside the same building. On one side, you had Henry Laufer's futures team. They were the old guard. Calm, measured, they drank coffee, read the paper. They really couldn't understand why Simons felt the need to keep growing. I mean, they were already making millions. But on the other side, you had Brown and Mercer's stock team, the new guard. And they were the complete opposite. Intense, super competitive, pulling all-nighters, sleeping by their keyboards. But here's the thing. They were generating twice the profits. They were the future of the firm.
And this tension, it wasn't just talk. It started having real, damaging consequences. You had newcomers starting these whisper campaigns against the older, well-paid guys, questioning what they were even contributing anymore. The whole place started to get this Lord of the Flies kind of feel. And so esteemed veterans, people who had been there for years, started to leave. It all came to a head in a shocking betrayal in July of 2003, when two scientists just up and defected to a rival firm. And they took with them, just as Simons had always feared, millions of lines of Medallion's secret source code.
So just as the firm is absolutely reeling from this internal crisis, I mean, a direct threat to its most valuable secrets, its founder, its leader, Jim Simons, is hit with a devastating personal tragedy, a completely random event that no algorithm in the world could ever predict or prevent.
His son, Nicholas, was just 24 years old. He was on this big, round-the-world adventure before he was supposed to start medical school. His death was just a shocking, random blow. And the irony is just heartbreaking. It's exactly the kind of outlier event his father's algorithms were designed to navigate in the financial markets, but it's something no parent could ever prepare for. And what makes it even more tragic is that this was the second son Simons had lost in an accident.
So here you have Jim Simons, a man who built an entire fortune on logic, on probability, on finding order in chaos, and he was just completely leveled by pure randomness. He just couldn't wrap his head around it, how he could have so much incredible luck in his professional life and be so horribly, tragically unlucky in his personal life. He was just grief-stricken and he completely checked out, and that created a massive leadership vacuum at the absolute worst possible moment for the company. So with Simons completely adrift, all those tensions that had been simmering for so long, they finally boiled over. The flashpoint was this one researcher, a guy named Alexei Kononenko. He was brilliant, no doubt, but he was also a total rebel, openly bad-mouthing the leadership, ignoring his assignments. It all came to a head at this really tense dinner meeting at Simons' house, where the top executives basically battled over what to do with him. It wasn't just about one guy, though. It became a proxy fight for the very soul of the company. The whole conflict hit its climax when one of the key researchers, David Magerman, just threw down an ultimatum. He basically said, "If we don't shut them down or fire them, I'm quitting." He saw this guy's behavior as a cancer that was destroying the firm's collaborative culture. But Peter Brown argued he was just too valuable to lose, and a checked-out Simons was worried that if they fired him, his whole team would leave and compete with them. In the end, pragmatism won. They made the decision to keep the rebellious team on board. So in the end, the firm was just left deeply, deeply fractured. And the whole episode really proved a profound irony, didn't it? Renaissance had built this unstoppable machine by systematically removing human emotion, bias, and gut feelings from trading. But they could never, ever write an algorithm to solve for the greed, the ambition, the jealousy, and the grief of the actual humans who had to turn that machine on every single morning.
Let's talk about one of the most secretive, most successful hedge funds of all time, Renaissance Technologies. Now, this was a firm built on one really powerful idea, that math, pure math, could conquer the markets, that you could build a model so perfect it would remove all human emotion, all human error. But what happens when that perfect model breaks? Today, we're diving into the story of one single week when a financial earthquake shook Renaissance to its very core and forced its legendary founder to make an impossible choice. Trust his creation or trust his gut.
All right, so here's how we're going to break this incredible story down. First, we'll look at why Renaissance even needed a new challenge in the first place, despite their wild success. Then we'll see how they tried selling their secret sauce to the public. After that, we'll relive the Quant quake of 2007, the week their models just stopped working. We'll dig into the dramatic split between their two big funds, and finally, we'll see how this whole crisis really marked the end of an era for the firm and its founder.
So picture this. It's the mid-2000s, and Jim Simons, the chain-smoking, code-breaking genius who started Renaissance, is facing a pretty weird set of problems. You know, the kind of problems you only get when you're just too successful.
I mean, his desk was piled high with what you might call high-class problems. His brilliant scientists were so rich they were actually getting bored and starting to fight with each other. His legendary Medallion fund, which was only for employees, was stuck at $5 billion. Any bigger, and its super-fast trading strategy just wouldn't work anymore. That meant they were finding all these profitable trading signals that they literally couldn't use. And to top it all off, Simons himself, well, he was looking for a new, grand challenge.
And you know, he really nailed the core of it all when he asked a colleague this very question. He wasn't just managing money, he was managing a team of certified geniuses. He had to give them a new mountain to climb, something to get excited about again.
So his solution? It was pretty brilliant, really. He decided to launch a totally new fund called the Renaissance Institutional Equities Fund, or REIF for short. And this thing was designed to be the complete opposite of Medallion. It would use those slower, longer-term signals they've been throwing away, it would be open to outside investors, and, in theory, it could grow to a mind-boggling $100 billion. It was the perfect new project to keep his team fired up and, of course, to expand the Renaissance empire.
Now here's the thing. Creating a fund for the public meant Renaissance had to do something they had never done before, and probably hated doing. They had to talk to outsiders. And when the most secretive firm on the planet cracks open its doors, even just a little bit, it creates an absolute frenzy. To sell this new fund, the sales guys started giving what the staffers jokingly called zoo tours. No joke, they would walk potential investors right through the office, pointing out the brilliant mathematicians like they were exotic animals. And over here, they'd say, is where they peer-reviewed new signals. The clients, of course, were completely starstruck. The scientists? They were mostly just annoyed that people were staring at them while they were trying to get a muffin from the kitchen. The mystique around these guys was so powerful, it could cover up some pretty hilarious mistakes. The co-CEO, Robert Mercer, a pure numbers guy who didn't follow individual companies, was trying to explain their system to an endowment. He used Chrysler as an example, not realizing that Chrysler hadn't been an independent company since 1998. Did the investors care? Nope, they wrote a massive check anyway. But the ultimate story, the one that really shows you how untouchable their brand was, has to be the cake incident. Simon Sikis is in a huge meeting with a major health foundation. He's a heavy smoker, and he can't find an ashtray anywhere. So what does he do? He stands up, leans across the table, and plunges his cigarette butt deep into the frosted vanilla cake they had for dessert. For a second, you could hear a pin drop. You have these health advocates just staring. And then, they eagerly signed on the dotted line. The allure was just that powerful. And the result of all this hype, all these crazy stories, by the spring of 2007, investors had plowed $35 billion into REIF. Think about that. Almost overnight, it became one of the biggest hedge funds on the entire planet. The machine seemed absolutely unstoppable. But you know how these stories go. Just when they were at the absolute peak of their success, the ground started to shake. In the summer of 2007, a storm was brewing in the markets that nobody saw coming, and it was about to put the core philosophy of Renaissance, trust the machine no matter what, to the ultimate test. It all went down in one absolutely terrifying week. On Monday, quant funds everywhere start bleeding money. By Tuesday, the losses at Renaissance were getting worse, and nobody could figure out why. By Wednesday, things got scary. We're talking margin calls from the banks. An emergency meeting is called. And then on Thursday, Jim Simons did the unthinkable. He stepped in and manually overrode the model.
In just a handful of days, the supposedly invincible Medallion fund lost over $1 billion. $1 billion! That was 20% of the entire fund, gone. The crucial point here is that this wasn't about making a profit anymore. This was about pure survival.
So inside that emergency meeting, you have this fundamental clash of beliefs. The guys who built the system, Peter Brown and Robert Mercer, they had this unshakable, almost religious faith. To them, the chaos was an opportunity. Their argument was simple. Trust the models. Let them run. In fact, let's buy more.
But Jim Simons, he felt something else. Not logic, but a primal, gut-level fear. He saw the real risk that the firm could go under, right then and there. He overruled his top guys with a simple human argument. Our job is to survive. He made the call to cut their losses and start selling, choosing human caution over algorithmic purity.
And to many of his own scientists, this was heresy, total betrayal. They were sending him emails telling him he was dead wrong. They saw it as a violation of the one core belief that had made all of them so successful. In their world, you either believe in the system or you don't. And their leader, their founder, had just blinked. In the chaotic months that followed, and then straight through the huge financial crisis of 2008, the consequences of that one human decision became brutally clear. It revealed a permanent, shocking split in the destiny of the firm's two funds.
The gap between the two funds didn't just grow, it became a chasm. I mean, just look at these numbers. Medallion, the employee-only fund, comes roaring back from the quake. It posts an 86% gain in 2007, then an 82% gain in 2008, a year the S&P 500 lost 37%. But REEF, the public fund, it was a disaster. It lost money in 2007, lost 17% in 2008, and somehow even lost money in 2009 when the market was soaring back.
The hype? It just evaporated. Investors who thought they were buying into the Medallion magic suddenly realized they bought something very, very different, and they ran for the exits. REEF's assets collapsed, falling from that high of $35 billion all the way down to less than $5 billion. As one of their own salesmen put it, no client on earth would touch us.
The Quant quake and everything that came after, it wasn't just a financial event, it was a cultural one. It really marked a turning point for Renaissance, leading to some high-profile people leaving, and ultimately, a fundamental change in who was in charge. Some of the original DNA of the firm started to walk out the door. Key scientists, guys like Glenn Whitney and David Magerman who'd been there for years, they resigned. They felt the firm had lost its way, that it had stopped feeling like a tight-knit university department and was now just about making money for other employees. They felt it lost its academic soul. And then came the biggest change of all. In 2010, at 72 years old, Jim Simons decided it was time. He passed the torch. And who did he hand control of the firm to? The very two men who had argued against him in that crisis meeting, Peter Brown and Robert Mercer. Simons, for his part, turned his focus to a new problem, figuring out how to spend the billions he'd made.
The new leadership had let's just say, a much less sentimental view of the public funds that had caused them all so much grief. When Peter Brown was asked about the future of RIAF, his answer was cold, hard logic. Basically, if it doesn't sell, we'll shut it down. The grand experiment had just become another product line.
So at the end of the day, we're left with this fascinating, incredible paradox. The greatest quantitative trading firm in history, a temple built to the power of pure logic and algorithms, was arguably saved from total ruin, not by its models, but by one man's gut feeling to ignore them. And it leaves us with a pretty fundamental question. When your entire world is built on infallible logic, what is the logic of ignoring it?
You know, inside the world's most successful and, let's be honest, most secretive hedge fund, two brilliant partners were quietly making fortunes that are just hard to even wrap your head around. One was Jim Simons. The other, Robert Mercer. They worked side by side, building this incredible money-making machine. And then they took their billions and aimed them at the future of America, funding two completely opposite visions. This is the story of how the quants who cracked the market tried to do the same thing to the country. Let's get into it.
So, on one side, you've got Jim Simons. He's the mathematician who decided to become a philanthropist, really applying that problem-solving brain of his to some of society's biggest challenges. And on the other side, Robert Mercer. He was the quiet computer scientist who turned into this incredibly powerful ideologue, dead set on remaking the entire political world, mostly from behind the scenes. They were partners at Renaissance Technologies, probably the greatest money-making machine in financial history. And this is the story of what happens when their money and their beliefs finally crashed into each other.
All right, so here's how we're going to break this down. First up, we'll go inside the money machine itself, Renaissance technologies. Then we're going to follow Jim Simons and his journey into philanthropy. After that, we'll trace how Robert Mercer became such a huge political force. Then we'll get to the main event, how their two worlds collided head-on in the 2016 election. And finally, we'll look at the aftermath of that collision. So, first things first, where did all this money and influence even come from? Well, it all started at a firm called Renaissance Technologies. This place is so successful and so secretive, it's basically a legend on Wall Street. This quote from Robert Mercer himself just perfectly nails the whole philosophy of the firm. See, they weren't looking for some magic bullet, some huge win on one single trade. Nope, they were looking for a tiny, almost invisible edge, just 50.75%, and then just hitting that edge thousands of times a day. That tiny, tiny advantage when you apply it over and over and over, well, that's how you build an empire. And what an empire it was. I mean, just look at this number. Their main fund, Medallion, which was only for employees, by the way, was pulling in average annual gains of around 65%. That's before fees. To put that into perspective for you, that record is so insane that most people in finance can't even believe it's real. It is without a doubt the greatest track record anyone has ever seen, period. So how on earth did they do it? Well, they didn't care about earnings reports or what some CEO said on the news. Instead, they were hunting for what they called multidimensional anomalies. Just think of it like a hidden code buried deep inside the market. These really subtle, complex mathematical connections between thousands of different stocks that no human could ever possibly see. They were basically code breakers for the market's deepest secrets.
But finding those little signals was really only half the battle. The true genius, the real key to their success, was the engineering. They built this massive, completely automated trading system that could suck in thousands of these weak signals, blend them all together, manage all the risk, and then make trades on a scale that is just mind-boggling. It wasn't just about being smart. It was about building a machine that was smarter, faster, and way more disciplined than any human could ever hope to be.
So after stepping back from the day-to-day grind at Renaissance, Jim Simons had this, let's call it, a nice problem. What do you do with all that wealth? Well, he decided to treat society's problems like they were the same complex math puzzles he'd spent his whole life solving. He truly believed the system could be improved if you just applied the right logic. And with a net worth of about $11 billion, Simons had the kind of resources to make a real, serious impact. He'd already been a huge donor, of course, giving hundreds of millions away to places like Stony Brook University. But now he was ready to really roll up his sleeves and get personally involved in tackling some of the world's toughest issues. He really focused his energy on areas where data and structure could make a difference. First up was autism research. This was personal for him, and it drove him to become the largest private funder in the entire field, creating this massive genetic database that has totally changed how scientists understand the condition. At the same time, he took on the crisis in American math education, creating Math for America to give top teachers the money, the status, and the support they needed to actually stay in the profession. And you can really see his mind at work here. Simons came at philanthropy exactly like he came at the markets. He didn't just write checks and walk away. No, he would identify a core problem, get the smartest people in the world in a room to talk about it, fund the most promising new ideas, and then, and this is the crucial part, he'd build the infrastructure to make sure the work would last. It was this systematic, data-driven hunt for solutions. Okay, so while Simons was busy trying to fix society's problems, his partner, Robert Mercer, was quietly coming up with a plan to totally remake society itself. He used that same analytical brain, but he came to a completely different conclusion. The system wasn't something to be fixed, it was a broken code that needed to be completely erased and rewritten. This quote is so important if you want to understand the guy. Mercer was intensely private. I mean, he once said he preferred the company of cats over people. For years and years, he was just this quiet, silver-haired programmer who pretty much kept to himself. And that reclusive personality is what makes his rise as one of America's most influential political donors so shocking. So what did this quiet man actually believe? Well, his worldview was built on a few core ideas, and they all pointed to one thing. The establishment was a failed system. He had this deep suspicion of government, a total dismissal of mainstream climate science, and just a profound hatred for political dynasties, especially the Clintons. For Mercer, these weren't just opinions. They were data points, proving that the whole elite consensus was corrupt and broken. It was a system that needed a hard reset. Mercer didn't just donate money. He built a machine. In 2011, he bought a massive stake in Breitbart News. He later put Steve Bannon in charge of it. Then, he invested in a data firm called Cambridge Analytica because he believed that super advanced data analysis was the key to understanding voters who felt left behind. So you see, piece by piece, with Bannon as his guide, he was building this whole ecosystem of media, data, and political strategy. But here's the thing. While Bob Mercer was the one with the money and the ideology, he needed someone to actually go out and execute the plan. And that person was his daughter, Rebecca. She became the public face of the whole Mercer political operation, going to fundraisers, meeting with operatives, and turning her dad's vision of disruption into a real, concrete, actionable strategy. So for years, these two partners really existed in completely separate worlds. Simons was building scientific foundations to make society stronger. Mercer was building a political machine to tear its conventions down. And in 2016, those two worlds were finally put on a collision course, with the presidential election as the battleground. And the divide? Wow, it could not have been more clear. Jim Simons poured over $27 million into Democratic causes. He was a key backer of the main pro-Hillary Clinton super PAC. At the exact same time, Robert Mercer became Donald Trump's biggest financial backer, funding the main super PAC that was trying to defeat Hillary Clinton. You had two partners from the very same firm using their fortunes to basically cancel each other out. By August of 2016, it really looked like Simons' bet was the safe one. I mean, the Trump campaign was just a mess. It was chaos. You had leaks, gaffes, no discipline, and donors were running for the hills. The consensus everywhere was clear. Trump was headed for a massive, historic defeat. But the Mercers saw an opportunity in all that chaos. At a fundraiser, Rebecca Mercer walks right up to Donald Trump. He admits things are bad, and she delivers this just stunning ultimatum. She says, "No, it's not bad, it's over, unless you make a change." In that one moment, you can feel the entire power dynamic of the campaign just shift. And she didn't just have a complaint. She had a demand, a non-negotiable one. She told Trump he had to bring in her people, Steve Bannon, the guy running their media arm Breitbart, to be the campaign chief, and Kellyanne Conway, who was already running their anti-Clinton super PAC, to be the campaign manager. It wasn't a suggestion. It was a takeover. And the Mercers got exactly what they wanted. Bannon and Conway took over. They professionalized the campaign's populist message and really sharpened its attacks. The political machine that Mercer had been building for years was now in the driver's seat of a presidential campaign. Which brings us to election night and two totally different realities unfolding for the two partners of Renaissance Technologies. And really, this slide says it all. In the Trump war room, a victorious Donald Trump turns to his team in just utter disbelief and says, "Dave, can you believe this? We just started this to have some fun." And at the same time, across town, Jim Simons had already gone back to his apartment. He couldn't even watch anymore. As his political advisor later put it, "We were pretty depressed." The total elation of one partner was the complete despair of the other. The great money-making machine they built together had spit out two results that just could not coexist. Which leaves us with a final, pretty unsettling question, doesn't it? The mathematical genius that powered Renaissance was all about finding hidden patterns and using them to make a profit. But what happens when that same analytical mindset, backed by billions of dollars, gets turned loose on our political system? When it's used to remake campaigns, build media empires, and fundamentally change the country's direction, what's the real legacy? The story of Simons and Mercer isn't just about two guys on opposite sides. It's about what happens when the logic of the market escapes the trading floor and starts to literally recode the world we all live in. And if that's the case, who's left to calculate the final price? All right, welcome to The Explainer. Today, we're going to pull back the curtain on a place that's, well, famously secretive and wildly successful, the hedge fund Renaissance Technologies. We're diving into a full-blown ideological civil war that just erupted inside the company. And it was all sparked by the 2016 U.S. presidential election, which literally pitted its billionaire leaders against one another. Okay, so let's jump right in. Picture this. It's the morning after the 2016 election. And that single moment, it just ripped open this huge, seemingly unbridgeable gap at the very, very top of the firm. So the date is November 9th, 2016.
For pretty much everyone, this day was all about political shockwaves, right? But inside Renaissance technologies, it was something else entirely. It was a massive turning point, one that brought this long, simmering internal conflict to a full, rolling boil. I mean, the difference in how they reacted, it couldn't have been more stark. On one side, you've got the founder, Jim Simons, in Manhattan. He's looking at all these anxious faces, just trying to hold his organization together. And then on the other side, co-CEO Robert Mercer is out on Long Island, getting ready for a huge victory party. We're talking two leaders, two completely opposite worlds. And it just perfectly illustrates this deep ideological divide that was about to blow wide open. You see, Simons was one of Hillary Clinton's biggest supporters. So here he is, trying to reassure his worried employees at his charitable foundation. He's basically telling them, look, ignore the political chaos. Let's just focus on our work, on our long-term scientific missions. It was a classic attempt to just, calm the waters. But at the very same time, a totally different scene is playing out over at Robert Mercer's estate. He's throwing his annual themed costume party, and get this, the theme this year was villains and heroes. The guest list? Oh, it was a real who's who of the new Republican inner circle, and they were all there celebrating a victory they had a huge hand in engineering. So to really get how this division got so bad, you have to understand the sheer scale of the Mercer family's political influence. I mean, we're not just talking about a few donations here and there. No, this was a targeted, multi-year insurgency, a plan designed to completely reshape the political landscape. And really, you can't overstate how important they were. This quote, it's from Steve Bannon himself. We're talking $26 million in spending. They put Bannon and Kellyanne Conway in charge of the campaign, and they had the unwavering support of Breitbart News, which, by the way, they funded. Bob and Rebecca Mercer were, without a doubt, some of the chief architects of that 2016 win. And it wasn't just Bob Mercer. His daughter, Rebecca, was absolutely not just sitting on the sidelines. She became a real power player inside Trump Tower during the transition. I mean, she was influencing key cabinet appointments and ended up with the title First Lady of the Alt-Right because of her huge behind-the-scenes role. Okay, but let's go back to the quiet, almost academic halls of Renaissance. Because while all this was happening, that same political victory was triggering a huge moral crisis for one of their top computer scientists, a guy named David Magerman. See, Magerman considered himself a political centrist, and he was just horrified. He saw this straight line connecting the code he was writing to the money-funding political policies he thought were cruel and honestly just abhorrent. He felt like his life's work had directly enabled a political outcome he just couldn't stomach. It really brings up a very modern question, doesn't it? When the tools you build are used for things you totally oppose, what's your responsibility? This whole crisis really came to a head during one very heated phone call. Word had gotten back to Mercer that Magerman wasn't happy, so Mercer called him up directly. And during that argument, Magerman says Mercer made this just stunning claim. He said that African Americans were actually better off before the Civil Rights Act, and he argued that the data showed it, just made them dependent on the government. Magerman was, as you can imagine, completely floored. He pushed back, and he pushed back hard. He argued that Mercer's purely data-driven view was totally ignoring the dehumanizing reality of segregation. I mean, for Magerman, this wasn't some abstract debate about numbers on a spreadsheet. It was about basic human dignity. So after that phone call, after realizing he just couldn't get through to Mercer privately, Magerman felt like he had no other choice. He did something extraordinary, something that, for an employee at a place like Renaissance, was basically unthinkable. He went public. He gave this explosive interview to the Wall Street Journal. Now, for a firm that values secrecy above pretty much everything else, the reaction was, well, it was swift and it was severe. The very morning that article went live online, Magath Merman got a call. You're suspended without pay and you're forbidden from contacting anyone at the company. Just like that. But the story was nowhere near over. The whole conflict reached its absolute climax a few months later, and of all places, it happened at a charity poker tournament. A nervous but still hopeful Magerman showed up, trying to repair the incredible damage he'd done to his career. So the night actually started off pretty promising. Magerman went up and apologized to Simons, which was a good start, but things went downhill, and they went downhill fast. It devolved into this shocking public confrontation, fueled by a little too much scotch and months of just simmering anger. And it all ended with Magerman getting physically kicked out of the event. And right at the heart of that whole confrontation was Rebecca Mercer. Magerman says she came right up to him, accused him of putting her family in danger, and then just repeatedly called him pond scum. It's such a raw personal insult, and it really shows you just how deep these wounds had become.
Yeah, any lingering hope of reconciliation was just obliterated that night. That clash at the St. Regis Hotel completely sealed Magerman's fate. 9 days later, after 20 years with the firm, he was officially fired. So now, the fallout from the Magerman affair and the Mercer's super high-profile politics, well, it wasn't just an internal problem anymore. The whole controversy spilled out into the public, and real, serious pressure started to build on Renaissance itself. And that backlash got very real very fast, both personally and financially. You had protesters gathering outside Mercer's home. The family started getting death threats. And then the money started moving. Institutional investors, like the Baltimore City Fire and Police Pension Fund, began pulling out millions of dollars, and they specifically cited Mercer's politics as the reason why. So you see, this wasn't just about bad press anymore. It was a huge signal that the firm's reputation was becoming a serious financial liability.
For Jim Simons, that was it. That was the final straw. He was convinced that all this controversy was destroying morale, that it was putting the firm's future at risk, and making it way harder to recruit the kind of elite, apolitical talent that Renaissance was famous for. So, one crisp October morning, he sat Mercer down and asked him to resign as co-CEO. Mercer, who apparently looked pretty sad and hurt, agreed to step down. And that really marked the beginning of a strategic retreat for the whole family from the political spotlight. But as we're about to see, the story, well, it wasn't quite over yet. So over the next year, the Mercers really did systematically lower their public profile. Bob Mercer sold his stake in Breitbart. Their political spending dropped way down. They even broke ties with Steve Bannon. Friends of the family said that the blowback was just so unexpected and so intense that it really forced them to take a much, much quieter approach. And yet, just a year later, Rebecca Mercer gets up on a stage at a gala in Washington, D.C. and delivers this incredibly defiant message. She acknowledged the backlash, sure, but she also made it crystal clear that her family's involvement in what she called the struggle for the soul of our country was going to continue. So this whole story, it really leaves us with a pretty critical question, and not just about one hedge fund, but about the world we live in now. In an age where data and wealth and ideology are all colliding, what are the responsibilities of the people who create the very systems that shape our society?
Today, we're diving into the story of the man who basically cracked the code of Wall Street. And in doing so, he kicked off this epic war between human gut instinct and cold, hard machine logic.
You know, this line from The Matrix, it perfectly captures a revolution that completely upended the financial world, and it was all led by one guy. But what's really fascinating is that, as we're about to see, even the guy who built the machine can start to lose faith in his own creation.
And for him, that moment of doubt, well, it came at the absolute worst possible time.
So, picture this. It's late December 2018, and the stock market is just completely nosediving. The S&P 500 is down almost 10% for the month. I mean, we're talking about the worst December for the market since 1931. Panic is definitely in the air.
And where do we find our guy, Jim Simons? At the Beverly Hills Hotel, of all places. Now, this man is worth something like $23 billion, but he cannot relax. He despises losing money, and he's just watching these numbers plummet day after day, feeling every single loss like a punch right to the gut. So what does he do? He picks up the phone, calls his money manager, and asks this one question, a question that goes against literally everything he has ever built. He's suggesting they should sell short, which is basically a bet that stocks are going to fall even further. And it's all based on nothing more than his own anxious human gut feeling. And that right there, that's the incredible irony of this whole story. Jim Simons, the man who built a financial empire by proving that machines are better than human emotion, was just seconds away from letting his own feelings take the wheel. The entire goal of his life's work was to get rid of gut instinct from investing, and in a moment of crisis, his very first reaction was to fall back on exactly that. You see, that one phone call is the perfect snapshot of this huge battle that was already raging on Wall Street, a battle between two totally different ways of looking at the financial world.
What's so interesting here is the contrast. On one side, you've got the old guard.
The guys who rely on their decades of experience, on digging through company reports, grilling CEOs, and ultimately on their gut. But on the other side, you've got the new way, the quant way, that Simons pioneered. And that's all about big data, incredibly complex mathematical models, and automated systems that execute trades without a human ever touching them.
And by 2019, wow, the old guard was really in trouble. The legends, these stars who relied on their instinct and old-school research, they were struggling. Even the great Warren Buffett was trailing the market. The titans of finance were discovering that their old magic just wasn't working anymore.
So you have to ask why. Why was this happening? Well, it's because the game had completely changed. See, it used to be that a hedge fund could get an edge by digging through endless reports to find some little piece of information nobody else had seen. But now, any financial number you can think of is just a keystroke away, instantly sucked up and analyzed by machines. That old information advantage, it was gone, vanished.
And all of this, it created the perfect vacuum, right? An opening for a totally new kind of investor. The quant revolution wasn't just on its way, it was already here.
So what in the world is quant trading anyway? Well, think of it like the science of finance. Instead of trying to guess or feel what's going to happen, quants use powerful computers to chew through just massive amounts of data. They're looking for tiny, hidden patterns, and then they build models that automatically trade based on those signals. And the whole point? To take human error, fear, and greed completely out of the equation.
And you want to know where this whole revolution started? Not in some sleek Wall Street skyscraper, that's for sure. Jim Simons' firm, Renaissance Technologies, started right here, in this totally unassuming building next to a pizza joint and a train station. It was like a quiet, mathematical rebellion brewing far from the center of finance.
And this is where things get really wild. The data they were using, it was on another planet compared to what traditional investors were looking at. We're talking about so-called alternative data. These quants are analyzing satellite pictures to predict how good the corn harvest is going to be. They're tracking cell phone data to see how much foot traffic is in Walmart parking lots. They use algorithms to analyze the vocal tones of CEOs on earnings calls to detect signs of stress. And yes, they've even looked into tracking late-night pizza deliveries to the Pentagon for clues that a crisis might be brewing. It's just incredible.
And the sheer amount of data out there for them to play with is just exploding. An estimate from IBM suggests that a mind-boggling 90% of all the data in the world was created in just the last 2 years. For the quants, this isn't just noise, it's a goldmine of potential trading signals.
So, you look at all this data, all this computing power, you'd think their system would be practically flawless, right? That they'd be right on every single trade. But the truth is actually way, way more surprising.
Let me just ask you this. How often do you think the single most successful hedge fund in history is actually right?
Okay, first, let's just look at the results. From 1988 all the way to 2018, Renaissance's main fund, Medallion, generated an average annual return of 39.1%. And that's after their massive fees. I mean, that is just an absolutely legendary, unheard-of performance.
But here is the jaw-dropping secret. Their system is profitable on just barely more than half of its trades, 50.75%. It's basically a coin flip. The most successful fund in history is right only slightly more often than it's wrong.
And that's the big takeaway here. The secret isn't about making a few brilliant home run predictions. It's about finding a tiny, almost invisible statistical edge and then exploiting it thousands or even millions of times over. And this is why it's so hard for any single person to beat the market. We look for those big wins. Renaissance wins not by being smarter on any one trade, but by having this tiny, persistent edge compounded relentlessly by machines that feel no emotion and never, ever get tired.
So, after you solve the puzzle of the market, one of the most complex systems on Earth, what do you do next? Well, for Jim Simons, the answer was pretty simple. Move on to even bigger problems.
I mean, if you look at his life, it's just this incredible progression of solving bigger and bigger puzzles. He started his career as a brilliant codebreaker for the NSA. Then he applied those same skills to crack the code of finance. And now, with the fortune he made, he's taking on the ultimate codes of existence itself.
He's now dedicating his foundation and his fortune to some of the most fundamental questions we can possibly ask. He's pouring money into research to understand and treat autism, which is a cause very close to his heart. He's backing projects to figure out how life even began on Earth, and he's building this massive new observatory in Chile to search for the echoes of the Big Bang, the very beginning of our universe.
So, in the end, what's the real lesson from the man who beat the market?
Maybe it's this. Whether you're looking at a mathematical proof, a trading algorithm, or the laws of the entire cosmos, there's a certain elegance, a beauty to a system that just works. And that, maybe, is the most valuable signal of all.